I'll start there. This is what, Tom, you're referencing here. A little bit of a different picture here where we see some buying of the 30-year and those yields coming down a bit. But that was not the story of yesterday. And it was that move, particularly at the long end, but other parts of the curve too, that spooked stocks. Today, the stock story looks spooked in China, down by just over 1% on the CSI 300. That's a combination of higher yields in the US, also disappointing data out of China on inflation, and not being supported by all of the talk about stock intervention we could see. The dollar index pretty flat today. We've got natural gas prices. I put that in because that was up 15% yesterday, up another 5% this morning, Tom, as we keep an eye on commodities.
Yep, the market mood has swiveled once again, and you're looking at futures in Europe pointing lower by 0.3 on the DAX. The FTSE 100 is looking flat. CAC Caron is looking down by about 18 points, Anna.
Okay, so futures suggest we will see a bit of weakness, picking up on that Asia weakness that we see through the Asia session today. So we're expecting a little bit of weakness on the European stocks, and we just see the FTSE 100 opening pretty flat. US futures have been pretty flat for much of this morning here in Europe, so we'll come to that in just a moment. But here we are, the FTSE is there. In terms of what we're seeing in other risk assets, the dollar is actually pretty flat. The euro and the pound then get space for a small gain, and this is the reversal of the sovereign bond trend of yesterday that we were just talking about there, Tom. We had seen in the US then those yields going higher as a result of the slightly higher than expected inflation print and all of the thinking about what that means for the Fed. Today looks a little bit different as you see the US 10-year yield coming down there, and it is in good company. We see yields coming down in various parts of Europe as well. Back to the stock open, and the Italian FTSE MIB is down by 0.2%. The Spanish IBEX down by a similar amount. But we are keeping an eye on commodities because just an hour ago this looked a fairly mixed column, and now we're seeing some further upside on commodities, and this could of course be linked to the geopolitics. WTI crude and Brent crude both up by at least 1.3%. Not a big move, but still standing out on the GMM. And the natural gas price, as I mentioned yesterday, up by more than 15%, today up by 5%. Tom, what do you see in sectors?
Yeah, oil prices on track at this point at least to end the week in positive territory, and the energy sector is one of 3 sectors that are in positive territory so far in the session. Very early doors, of course, but currently energy as a sector gaining 0.5%. It was the leading sector yesterday across European equities. Basic resources, by the way, gaining as well, 0.7%, despite the softer inflation data coming out of China. And of course, you do have the news that maybe there's going to be support for the equity markets. But basic resources gaining 0.7%. The consumer is flat after the losses of yesterday. Technology down 0.7%. It was one of the leading gainers yesterday, giving up some of those gains in the session today on the back, no doubt, of higher yields. Across your benchmark here in Europe, just losses of 0.2% so far, Anna.
Okay, let's get a perspective on the markets then. Sam Unstead joins us from the Markets Today blog and can give us thoughts on what is driving markets and beyond. Sam, let's start with the Fed, because this is a conversation that obviously is dominating market thinking. And at the start of the week, we picked up from last week where a lot of the dovish commentary from the Fed was dominating. But then that's kind of come face to face with the data, which has looked a little hot in some places.
Yeah, certainly. I mean, so we had the jobs report last week, and then consumer price index yesterday, slightly hotter than expected. I think it is interesting that the debate there, we were just talking about the BOE being very finely balanced. It feels like it's very similar for the Fed at the moment. You know, and in particular, what's come forward for the Fed is this question of the rise in bond yields. Is that going to do the financial tightening that that rate hikes would otherwise need? So there's a really, I think, a very precarious question now for the Fed as coming into their next meeting.
And that bond market reaction was pronounced yesterday.
Yeah, it was. It was very significant. And I think also, at the moment, and certainly over the course of this week, partly because of this big external shock that's happened in the market, bonds are very volatile, it's certainly in comparison to how they've been historically. And so, trying to measure what the Fed's going to do just based on bonds does seem like, again, quite a precarious question. And
China in focus. From a market's perspective, we've got a number of themes to deal with in the China story today.
Yeah, I mean, you guys just mentioned, actually, that the contrast between the two is very significant. And I think with China, again, the data that's come out today, the inflation data in particular, shows that there's still some work to do. The stimulus has started to come through. Yeah, it doesn't appear to have done, but the question is, will it? And we had this story, obviously, earlier in the week as well about bank stocks, about them stepping into that market. All these different pieces of stimulus all around the corners and all around the tangents of China's economy. When will they start to kind of cohere?
Yeah, and more broadly, of course, that inflation divergence and the impact on asset markets and fund flows as well. Sam Unstead, of course, breaking down some of the key market themes for us today. You can get more, of course, from Sam and the rest of the brilliant team on the Markets Today blog, on the website, or by typing TLiveGo on the terminal. Coming up, big banks and bad loans. Wall Street's biggest lenders kick off earnings season today. Yes, we are back there. We're going to let you know what to expect. That is next. This is Bloomberg.
CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
This is Markets Today. We are 7 minutes into the European trading day. You're seeing losses across European equities of around 0.2%. Let's get back to the latest now on the Israel-Hamas war. And Israel has called for an evacuation of all civilians in Gaza City and told the United Nations to move its staff away from the area, suggesting a ground operation could be imminent. Joining us from Tel Aviv is Bloomberg's Oliver Crook. Ollie, what is the latest?
That's right, Tom. That is a sort of significant development of the last few hours. The Israeli Defense Forces saying that calling on Gaza City and the civilians in north of Gaza to evacuate and to move south. We heard a briefing from the Israeli Defense Forces that they're saying that they're going to continue to operate significantly and continuously in Gaza City. They say they will make extensive efforts to avoid harming civilians that they claim Hamas are using as human shields. We're talking about an area that has more than 1 million people in it. We're talking about displacing more than 1 million people. The United Nations has said that it considers that impossible without devastating humanitarian consequences. The UN went on to say that they strongly appeal for any such order to be rescinded, avoiding what would transform already a tragedy into a calamitous situation. And the tragedy they're referring to on the ground in Gaza are the more than 1,500 that are dead, the thousands and thousands that are injured from Israeli strikes, and that health services that are completely overwhelmed, infrastructure that has fallen apart. And Israel has continued to strike overnight with more than 750 strikes, having dropped more than 6,000 bombs since Saturday. And that, of course, in response to the attacks on Israeli soil that left, now we understand, 1,300 dead since Saturday, mostly civilians, mostly in the attack on Saturday, more than 5,000 rockets that have come into Israeli territory. And stepping back, the Israeli government, this wartime government, has vowed to crush Hamas. And how to do that involves, most likely, and is widely anticipated, a land invasion. And we know that there are more than 300,000 soldiers that are positioned outside of Gaza. We do not know whether they will go in yet. The government is apparently undecided yet, or will not divulge whether or not they will, but the military is in position to do so. The next question is about humanitarian aid and how to it will be able to establish a humanitarian corridor. The United States is apparently speaking to Egypt about this because, of course, if we're displacing 1.2 million people, this is half the population of Gaza, to the lower half of the country, it's already one of the most densely populated places on the planet.
It is, and so we watch this very closely, Oliver, and policymakers around the world watching this and commenting on it, and some of them actually making trips to the region. What do we expect?
Yeah, so we have Ursula von der Leyen, who is arriving here today. We expect the U.S. Defense Secretary to also come to Israel, and also foreign ministers from Germany, Italy, Canada. And really, we expect them to echo the message from Antony Blinken, the U.S. Secretary of State, which was full-throated support for Israel for military operations, but also a second message, a more tacit message, which is about showing caution. And really what he said was this: it is so important to take every possible precaution to avoid harming civilians, and that's why we mourn the loss of every innocent life, civilians of every faith, every nationality who have been killed. And this, of course, in anticipation of what is the possible ground invasion, which would see a very challenging terrain to wage war against an enemy for Israel that is not, a military. And this comes also in a broader context with Blinken going to Saudi Arabia, United Arab Emirates, Qatar, to have sort of diplomatic talks to see how to sort of contain the fallout. We've heard from Hamas that has called for a day of rage today on Friday across the world, which the Israeli government has warned any Jews or Israelis abroad to approach. And of course, we've had the comments from Iran saying that a second front could be opened if the continued attacks, the attacks continue from Israel into Gaza.
Yes, and with that in mind, interesting to note just a headline on the Bloomberg terminal, Oliver, that says that the Iranian foreign minister is meeting Hezbollah's leadership in Lebanon. So we'll watch these developments carefully. Thank you very much for the update. Bloomberg's Oliver Crook in Tel Aviv. Let us get an update on some of the other stories that are well read on the Bloomberg terminal. We have an update on some other stories for you this morning. In U.S. politics, Steve Scalise has dropped out of the race to become the U.S. House Speaker after he struggled to gain enough votes for a majority, deepening turmoil in the Republican Party. The Speaker position has been vacant for 10 days, leaving the House in a holding pattern and unable to approve aid for Israel or Ukraine. Ford says its offer of a 23% raise to the United Auto Workers Union is the best it can do. Sources tell Bloomberg the firm had indicated to the union that it could add to its offer made early last week. The UAW is looking to emerge from the strike with a 30% pay rise and other improvements in conditions. Bloomberg understands that Jim Ratcliffe is emerging as the frontrunner to buy the English football giant Manchester United. The British billionaire's recently revised offer is said to give him the edge over a rival proposal from Qatari investors. We understand the Ineos chairman is in talks with the club's US owners, the Glazer family, over the structure of the deal.
Okay, let's get to the earnings story now. And the biggest US banks are poised to write off more bad loans than they have since the early days of the pandemic. This as higher for longer interest rates and a potential economic downturn are putting borrowers in a bind. We're going to get some insights later today as JP Morgan, Citigroup and Wells Fargo kick off earnings season. And for a preview, let's bring in Bloomberg's Charlie Wells. Charlie, what are we going to be expecting? What are we looking for?
Well, look, this is sort of the dark side of net interest income. So for so many quarters and so many of these earnings reports, banks have been reaping the benefits of higher interest rates. They've been able to charge more for loans than they've had to pay out to depositors. But we're seeing analysts talk about some concerns about this, about competition for some of these customer deposits as they can approach things like money market funds or CDs, but also some softening on loan demand from consumers who are struggling with inflation. I mean, beyond interest rates, there's the issue of investment banking revenue. We're also seeing a very different trading year than the year last year, which was so volatile, with Citigroup expected to be the only major bank here to post a potential increase in revenue from trading.
Okay, so we'll focus on Citi there. Who is expected to come out ahead then, and who are the laggards going to be in this group?
So the big guy up ahead is JP Morgan. And if you think back to earlier this year with that banking crisis, of course, JP Morgan was actually able to come out of that larger and stronger. They're expected actually to post a huge increase in net interest income. And when you look at their expected earnings per share, it's expected in this quarter to be up 26%. You compare that to another bank reporting today, Wells Fargo, expected to be down on earnings per share 4%. Citigroup expected to be down 18%. So down 18% for Citigroup compared to up 26% for JP Morgan.
What about the activity in the investment banking parts of these businesses? We've been desperate to hear that it's coming back, or at least many people have been desperate to hear that it's been coming back. Any sign of that? Are we expected to get clarity in terms of M&A, IPOs, underwriting?
Well, these are investment banks, and so where is that investment banking activity? I mean, for a long time, we were talking about potential green shoots coming from the likes of, say, that Instacart IPO. We had the Birkenstock IPO. We had the ARM IPO. That's just on the equities underwriting front, right? So this M&A activity has been so muted that it's still looking like at a number of these banks, we're going to see, not great fees coming from that investment banking side.
And what's the bigger picture here then, Charlie, in terms of the US and even the global economy? Because we sometimes get some really interesting clues, certainly around the US consumer, from bank executives and what they tell us in these reports.
A lot of analysts have been looking at that loan loss provision and these net charge-offs. So according to some Bloomberg data, these four big banks are expected to set aside $5.3 billion in net charge-offs for the quarter. So that is a lot of money that these banks are expecting not to get back from consumers. And some bank CEOs have been talking about, consumers on the lower end of the creditworthiness score potentially coming into some trouble. And I should just note, and I speak from personal experience, in October in the United States, student loan payments are coming due again. And that is one of the last pandemic era policies to sort of come unwound. And that could put millions of households under pressure as they have these expenses coming up.
Charlie, thank you very much for the update. Certainly a sector we will continue to watch. Charlie Wells with us on the banking sector. Coming up shortly on this programme, we'll be joined by Kristalina Georgieva, the IMF Managing Director. That interview coming up shortly, live from the IMF and World Bank meetings taking place in Morocco. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Welcome back. This is Markets Today, 19 minutes into the European trading day. Now, the IMF and World Bank annual meetings have been taking place, of course, this week in Marrakesh. Dominating the agenda has been the geopolitical risks from the war in the Middle East. Let's cross over now to Bloomberg's Tom Keene, who is in Marrakesh with a very special guest. Tom.
Thomas, thank you so much. Of course, with me, the Managing Director of the International Monetary Fund, Kristalina Georgieva. I'm thrilled to tell you we have a panel this afternoon, and she has stood me up. So we will talk to her now about this. What an honor to travel 200 miles here from Marrakesh up to Rabat to see Mohammed VI. What will you say to the king about these meetings?
I will thank the king for the generosity of Morocco to host us despite the earthquake on September 8th, and for the warmth that is extended to us by the Moroccan people, and also for the demonstration of solidarity that we want to absorb for our global family. We need each other in these turbulent times.
What is so important is the 50-year span from Nairobi over to where we are now in Morocco, and it's a testament to every effort to bring the North and the South countries of 180, 190 countries together. What is the symbolism of being here again in Africa?
We're here in a very difficult time for the world economy. In 1973, when we were in Kenya, it was also a very difficult time for the world economy. If you remember, that was just the collapse of the Bretton Woods system. Mm-hmm. At that time, people did not solve all problems during the meetings, but they paved the way to solving them. Mm-hmm. And now we are also in a very charged time. Being here in Africa is so important. Why? Global growth is anemic, at 3% on average, way below what we need to recover from the shocks and to lift up everybody. And here in Africa, we have youthful population that can be the engine of growth for the world economy. If we unlock capital in rich countries, aging societies, mm-hmm. to move to this youthful continent on scale would be great for Africa, great for the rest of the world.
Some of the themes we'll talk about in this conversation, but first we have to look at your wonderful effort on fragmentation, your article in Foreign Affairs. I really can't say enough, folks, the importance of this article in Foreign Affairs. The writing of Georgieva just leaps out of it. I looked at it and I said, I don't think there was any help on this. You wrote that article yourself, didn't you?
I did.
You did. I mean, it was like back to school with you. Dr. Georgieva, tell us about fragmentation, but give it a different twist now, which is this appalling moment in the Eastern Mediterranean, the dark clouds that you spoke of the other day.
What we have seen over the last decades after the end of the Cold War was a lot of positivity coming from an integrated world economy. It served us well, but we neglected the fate of those who did not benefit from it. Communities where jobs disappeared overseas, and there was no help to create new chance in life. So our complacency to the fact that globalization lifted up the world on average, but left millions of people behind, and this became a breeding ground for populism, for this sentiment against others. That complacency we have to admit. Why we should nonetheless work to build bridges across economies? Because we do need more economic prosperity for everyone, and that can only come from a world where we have the ability to trade more, so cost of the totality of what we produce goes down. We calculated the cost of fragmentation just on the issue of trade. If we do it well, in other words, we strengthen security of supplies, but do it wisely, not willy-nilly throwing the baby with the bathwater, the cost would be minimal, 0.2% of GDP. If we are reckless, it can go all the way up to 7% of global GDP.
Right now, we are reckless. We have a war, and I loved your phrase from the other day of dark clouds. There is a fragmentation in the Eastern Mediterranean. Please comment, as all institutions are and all leaders are, on how you perceive this Israel-Hamas war.
My heart bleeds for the people in Israel that were slaughtered. My heart bleeds for the people in Gaza that now, the civilians, not the militants, the civilians that are paying such a high price. We pray for resolving this conflict as quickly as possible. The longer it goes, the more the risk of spillovers grow. And where we are as a world, we simply cannot afford more uncertainty, more hatred. We are so much into pointing fingers at each other, and we are in a world in which we need to hold hands. So fast resolution is what would help people, and it would help the world.
Can you affect a dialogue, for example, between Egypt and Israel right now, as we saw in '67 and along the path of these tensions? Can the International Monetary Fund provide guidance or assistance to figure out a relationship between Israel and Egypt over this territory?
Our duty of neutrality is there because we have to be able to provide objective policy advice on economic matters to all our members. There are institutions that are a better fit to bring countries together on a political level than the fund. What the fund is concentrated now on is to very carefully monitor what could be the economic impact of the new eruption of tensions in the Middle East. So far, what we see is relatively contained. Oil prices are going up and down, but there hasn't been a huge spike. Some nervousness in markets, understandably. And this is why I'm emphasizing the sooner there is a resolution, the better for everyone.
I have to, just because of the brevity of the meeting and your busy schedule here in Marrakesh, I have to ask, which a word that I use is the sequence and the timing and the impatience to get things done. and it can be debt restructuring or dragging China into some dialogue of how to restructure. That's Gita Gopinath, among others, has talked about that. It can be the debate of quota and how the IMF moves to a new regime. Tell me not about those specifics, but tell me about the sequence you see to get to a constructive resolution. Is it a sequence to Thailand 3 years from now, or is it a sequence to 3 months from now?
Excellent question.
I did okay there?
Oh, great question.
I had 5 people tell me how to ask that question.
Well, the story of debt today is very different from the story of debt 20 years ago. We have a vastly different creditors landscape. Private sector creditors, new, old, bilateral creditors. Right. How do you bring order in that resolution when there are so many parties involved? What we have done is we brought traditional creditors, new creditors, China, Saudi Arabia, Brazil, India, the private sector, and debtor countries in what we call Global Sovereign Debt Roundtable. What is the purpose? Identify the sticky points and then one by one clear them. I'm a very practical person.
What is the timeline of this? The mystery here in Marrakesh is the sequence or timeline to get to a first resolution.
Yes, so here is what is happening with the timeline. Because of this experience that is being built case by case and lessons drawn, when we had chat, it took 11 months from staff level agreement to getting financial assurances and go to board. For Zambia, 9 months. For Sri Lanka, 6 months. For Ghana, 5 months. We want to go down to 2 to 3 months, and that can only be done by practically identifying what are the steps and then getting creditors to agree to march on the same tune so resolution can happen faster.
I have one final question. It's short, and somebody in America said I have to ask. Have you had the time to go into the acclaimed square of Marrakesh in the souks like Jimmy Stewart and Doris Day did in that movie years ago?
Look, I had to go. I need to feel the spirit of this city.
Did you buy something?
No, I didn't have time. It was like zipping in and out. But it is amazing, and the colors here, they create unique atmosphere for our meetings, Tom. Let me tell you one thing. Marrakesh has this ability to create a consensus building environment. We have been raising money for our poorest members, for our zero interest rate loans. And the miracle is that our universe of donors has expanded here in Marrakesh dramatically. Trinidad and Tobago is now a donor. So countries rich and poor together united.
We will continue this discussion in Thailand. Tom McKenzie from Marrakesh, this has been a wonderful conversation. Back to you in London.
Tom Keane on the ground there with, of course, the Director General of the IMF on the needs for faster debt resolution. Thank you very much indeed. Let's check back in on these markets then. On a down day broadly for these equity markets in Europe, the benchmark European Stock 600 is down about 0.1%. It's a slightly different picture when you break out the UK, though. The FTSE 100 is just eking out gains of about 0.1%, as you can see there, adding 5 points. The DAX is down 0.3%. And over in France, the CAC 40 is trading at 7,095, just down 9 points, Anna.
And let's have a look at the sectors picture this morning. This Friday morning, you get an explanation, really, of what's going on the FTSE and why we see that outperformance, because the energy sector is certainly the best performer. It's up by 0.75%, that sector. Utilities also are not doing too badly. I mean, broadly speaking, we're split on between those sectors going higher and those going lower. I will point out 2 sectors at the downside, though, that are of interest. Healthcare down by 0.9%, and that includes Sartorius, which is over in Germany, but it has a French subsidiary, and both Sartorius and its subsidiary are dropping heavily today, down over 12%, as a result of the warning we've had, a profit warning is how it's termed by Morgan Stanley, on lower volumes and product mix effects. This warning coming in worse than expected. This is in the life science and diagnostics division. And the other sector, Tom, that stands out on the downside is financial services. And I know that you've been looking at some of the details around that. St. James's Place, one of the fallers there.
So St. James's Place is weighing on that sector, absolutely. That stock currently down 9.8%. They have said that they're going to be reviewing their fee structure. There's been a lot of controversy around St. James's Place's fee structure for a while. There's been some FT reporting today suggesting that there was more scrutiny on this business. And again, the response from St. James's Place is that they are looking to revamp and review their fees and charges. And that is weighing on the stock 9.8%. And as you say, weighing as well on the financial services sector. Let's get back to the energy story then and what is happening in terms of the pricing around Brent and WTI. And you've seen a spike actually in prices in the session today. Brent is now at $87.64, up almost 2%, 1.9%. WTI closing in on $85 a barrel, gaining 2%. And of course, you do have the geopolitics front and center now when it comes to the oil price story. And you're seeing prices reflecting some of that anxiety. Anna.
Okay, certainly an interesting morning in markets. Let's get back to the IMF and World Bank meetings, though, in Marrakesh for another big exclusive interview. Francine Lacroix joins us from Morocco. Fran.
Thank you so much, Anna. And joining us now is Christian Saving. He is the Deutsche Bank Chief Executive Officer. Christian, as always, thank you so much for coming on. It's a bit of a strange week because a lot of the focus is on the, of course, atrocities, the human loss of life between Israel and Hamas. But the focus here is on growth, on whether we have more inflation. So how do geopolitics going forward come into your thinking of where the world is headed?
Oh, first of all, thank you for having me. Look, I think we are living in a time since the war in the Ukraine, since the start of the war in the Ukraine, where geopolitics have actually and are leading the economy. So it's kind of exactly the other way around, like we used to know it from the last 10 or 20 years. And as a bank and as all participants in the economy, you really need to watch out carefully. I do believe that last week's events, the horrific events which we have all seen, did not really have a material impact yet on the economy. But this is exactly the dangerous part, because it only needs one or another event, and you see actually a huge or a bigger impact on the markets. What does it mean? We need to stay vigilant. We need to stay diligent. I think our clients really need the advice to risk manage their positions, and that's where we are here and why we are there for our clients. And that's actually the major discussions here in Marrakesh. What is the potential downside? How do we actually safeguard our clients? How do we risk manage the positions?
Christian, we understand that certain banks have actually limited travel for their employees in the Middle East. Are you going to take similar steps?
No, not for the time being, because I think we have obviously done all the measures which we need to do for our people in Israel. We are watching the situation very carefully. On the other hand, I also don't want to be now in a position where we are simply issuing travel warnings across the region, because sometimes I think that rhetorics and communication can make a situation even worse. And that's what we should not do. We should be balanced, we should watch it, we should risk manage it. That's what we are doing.
And as you say, the markets for the moment haven't really focused on it, but could it change the dynamic in terms of inflation and therefore when we'll see peak interest rates?
Look, a lot of focus is obviously now from this event, which we have seen last weekend, on oil price. Oil price has always an impact on inflation. But even outside and aside of the awful events from last weekend, I think we see a stubbornly high core inflation. The markets were somewhat surprised yesterday with the US numbers. And I do believe that overall we see that interest rates will stay higher for longer. Whether we see another step or not, to be honest, very, very hard to tell. I think it's not completely unthinkable that there is another increase also on the Fed side. But overall, we as Deutsche Bank, we are clearly believing that the interest rates which we see right now will be there for longer. And again, that is something where our clients need to position for themselves, and that will obviously have an impact also on the economic development next year and in 2025.
There's a lot of concern about the German economy and actually where it's headed. Do you see any stress or any points that we should be careful about amongst your clients in Germany?
Yeah, I'm glad that you're asking me because, there is a lot of discussion, as you said, Germany is a segment of Europe. By the way, I don't think that Germany is a segment of Europe, but Germany needs some structural reforms, and that needs to happen now because Germany obviously benefited from our exports to China. Germany benefited from low energy prices. Germany benefited from low interest rates. All that changed, and we need to get adjusted to that. But it also means we need structural reforms with regard to energy prices, with regard to infrastructure, immigration, and so on. If we do this, and this is what we jointly have to push for, the economy, but also the government, if we do this, I think Germany actually will see growth again, potentially not the number which we all wish in 2024, but from 2025. With regard to the economy in itself and the resiliency of our corporates, I'm actually seeing a picture which does not worry me. I think there is a lot of resiliency in the portfolio. But again, the real issue is the look forward, and therefore structural reforms are urgently needed now.
But Christian, given the cost of credit, how much do you worry about commercial real estate, which is the one thing that most investors worry about, of which you have a large chunk in Germany of?
Well, certainly it's an asset class which deserves monitoring. But again, fortunately from a Deutsche Bank point of view, I think our portfolio is very much contained. We have reported about that. I do think that commercial real estate, in light of the higher interest rates for longer, but also all the developments which we have seen from COVID on with work from home, is an asset class which will actually go through a more difficult timing for the next couple of years. But it all depends on your underwriting principles, and there I feel very comfortable with that, what we have done.
Overall, we've seen a lot of volatility in the markets, and some have been on the right side, some have been on the wrong side of bets. I know your trading revenue declined in the third quarter. What have you seen since?
Well, I cannot yet comment on the third quarter, but overall, to be honest, I'm very happy also with the trading business overall in Deutsche Bank and what Ram and Fabrizio have established over the last 4 years. I think we have come to a place that in particular in certain markets, in particular in the European markets, we have a market-leading trading business. And if you are market-leading, then the stability is always higher than if you're not market-leading. This is exactly what we wanted to achieve, and we achieved it. I think the overall goal of Deutsche Bank, and this is what we established, is that we are less dependent on the investment banking. And in this regard, we significantly strengthened our corporate bank, our private bank, the asset management. And we did investments, and we just closed it this morning, the Numis investment, where we want to strengthen the capital light business and the advisory business within the investment bank so that the investment bank in itself gets even more diversified. That's what we achieved, and this makes me happy.
And so, Christian, what comes next? Again, this is when you look at revenue-generating businesses after the acquisition at Numis, which was almost a watershed moment, right, after the difficulties of restructuring the bank. Is there anything else that you want to grow in or even buy?
No, there is, with regard to that, look, we are obviously always looking at the market, but I think the main focus this bank has is profitable growth by itself. And I think we have seen a good momentum, in particular in the stable business over the last 2 years. Of course, the net interest income helped, but if you really see the underlying mandates we have in the corporate bank, but also in the private bank, then I can really see this bank is on a growth path. We need to do it in a very disciplined way. We cannot let our eyes off the costs, and we need to do it in the environment which we just discussed with strong risk management. But I do believe that Deutsche Bank is there where we want it to be on a sustainable growth path. If we stay disciplined on costs and risk, I'm actually very confident about our future.
But what's your biggest concern in terms of outside shock that could come?
Look, it's those concerns, Francis, which are, to be honest, hard to expect and hard to forecast. Like, to be very honest, last week's events were not on our radar screen. For that, you need to be prepared, and therefore I'm always telling that in a world where geopolitics are leading the economy, you need to be extra vigilant on your risk management. We have done that, and therefore we have not suffered from all these items. But of course, if there is a further escalation in the Middle East, then we may face a different picture. And therefore, risk management monitoring is something which is on the top priority of Deutsche Bank for the time being.
Christian, thank you so much for your time today. That was, of course, Christian Saving, the Deutsche Bank Chief Executive Officer. With that, Tom, I'm going to hand it back to you in London, and we have plenty more interviews throughout the day here in Marrakesh.
Okay, Francine Lacroix on the ground for us in Marrakesh. Thank you very much indeed. And as you said, we have plenty more coming up, including, of course, from those IMF and World Bank meetings. We're going to be speaking to the Spanish Economy Minister and the Deputy Prime Minister, Nadia Calviño. That is live from Marrakesh. That is next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We are 45 minutes into a European trading session that looks fairly varied. The FTSE 100 pushed higher by energy stocks. Let's get back to Morocco, though. Bloomberg's Francine Lacroix is on the ground for us at the IMF and World Bank meetings, and she's joined by a guest. Fran.
Anna, thank you so much. Joining us now is Nadia Calviño, Spain's Economy Minister and Deputy Prime Minister. Deputy PM, thank you for joining us. It's a little bit of an odd meeting because a lot of the focus is on energy prices, a lot of the focus is on inflation, whether it's contained, and some of the geopolitical concerns. Do you worry that energy prices go higher from here, and what that means for what Spain can do to contain inflation?
Well, it's too early to know what the impact of this terrible conflict could be. We should be prepared for anything, you know, but in the last couple of years we've been able to deal with very complex situations in a good manner, and I think that in an increasingly troubled geopolitical context, it's good that the geoeconomic side of things, the G20, IMF, World Bank, are actually providing stability and trust.
What's your biggest concern in terms of the tools that we have in Europe to fight inflation? So there are a number of measures also that the government has put in place in Spain. Do these have to stay on longer?
Well, we've been quite successful in Spain. Indeed, we were a bit the canary in the mine because when energy prices started to rise at international level, we felt it immediately in 2021, and we set in motion a number of measures to contain the impact on inflation, which have been very successful. So we just got the data, the latest data today, and we're around 3%. Core inflation is also going down already. So they're being effective. Between now and the end of the year, we'll have to see whether some of these measures need to remain in place, always with a focused approach and a temporary approach, so that we ensure that we make the best possible use of public resources and regulations.
What do you worry most about Spain and Europe in general? That inflation becomes entrenched, so it doesn't really go higher, but it doesn't also, it's stubbornly high?
No, I think that for the moment we see that monetary policy is having an impact. You know, inflation is going down. I think that we need to ensure that Europe continues to have strong growth. Fortunately, in this very troubled and slowing down context at European and global level, Spain is doing quite well. We've had a very strong rebound after the pandemic, very strong growth in 2021 and 22, and the drive continues in 23. So that's good news. Everybody expects Spain to be the fastest growing large economy in the EU this year and next. Labor market continues to go strong. Investment is strong also. So we can also continue to be an engine of growth for the whole of the EU.
So you don't worry about a credit crunch or something? We were talking about commercial real estate. Is there anything again in Europe that could then have a spillover on Spain?
No. We have, since the global financial crisis, you know, in 2008, the financial sector was restructured. There's been very strong deleveraging of corporates and families. Sovereign debt is also going down. We will be below 110% of GDP this year, thanks to very strong growth. So we're taking the profits coming from strong growth and the tax revenues to be as fast as possible reducing our deficit and debt to GDP ratios. And I think this is what we should be doing. You know, fiscal responsibility is our top priority right now in the current turbulent financial environment.
Deputy PM, you're also looking to lead the EIB. So how much support have you had for that so far?
Well, I am quite confident, you know, that our candidacy is strong. I have received very warm welcome from all colleagues in Europe and a strong support. So I hope that between now and the end of the year, this will be a successful candidature. But as you know, Francine, all these matters, you know, are very complicated. So you can never take anything for granted. But I think I am a strong candidate and I have received a very strong support.
How do you see the EIB actually potentially changing in the next couple of years?
Well, I think the EIB is a very important institution for Europe, and it will be even more important going forward, precisely because with high interest rates, the fact that we have a very strong, very large development bank is the largest in the world, and that we can play a key role in funding the necessary investments for the public and the private sector in the areas of digital and green. I think that's going to be an even more important tool in the coming years. And that's what prompted me, you know, to put forward my name, because I am very motivated to lead an institution that can really make a difference.
Do you see going forward more private-public partnerships? Or, again, given the uncertainty of the world that we live in, interest rates, private markets, where do you see the most opportunities actually to make a real difference?
I think it's indispensable that we foster public-private partnerships and cooperation. Otherwise, we won't be able to mobilize the billions and trillions that are necessary to succeed in fighting climate change, which is a global endeavor. And so in Spain, we are doing it. You know, we are using the European funds, the Next Generation EU funds, to foster public-private investments. And we're being very successful with that, and also attracting talent and investment from abroad. And at the European level, we definitely need to do that to mobilize the investments that we need. And I think that's also a challenge that will be key in the coming years at the global level. And the World Bank and the IMF are going to develop new tools and new mechanisms so that we can work better together.
There's been a bit of political uncertainty in Spain. And what happens next?
Well, the election result was very clear, and I am personally very satisfied that the Spanish people said we don't want the ultra-right-wing, ultra-conservative Vox party in the government of Spain. They are already in some regional governments, and the first things we see is they cut down on LGTBI rights, women's rights. So I'm very satisfied that Spain will continue to be a progressive country, pro-European country, contributing to stability. And I am confident, that we will be able to form a government, and President Sanchez will continue to be leading the next government in Spain, and providing stability and continuity on the economic policy front also. It's reassuring also, I think, for markets and corporates and investors that Spain will pursue the path that we've been leading in the last 5 years, which is having very good results.
Nadia, thank you so much for joining us. Nadia Calvino there, the Spain Economy Minister and Deputy Prime Minister. With that, I'm going to send it back to you in London. And of course, we'll have plenty more from Marrakesh throughout the day.
Okay, Bloomberg's Francine Lecoq on the ground for us in Marrakesh. Thank you very much indeed. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise?
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
It's Friday. This is Markets Today, 55 minutes into the European trading day, and you're seeing losses of about 0.1% across the European benchmark. The FTSE 100, though, just eking out some gains for you on the back of the upside that's coming through from oil prices, and we'll give you more detail on that story in the next couple of seconds. The DAX, by the way, over in Germany, currently trading at 15,391, down 0.2%. Let's flip the board then and have a look at the moves in oil, because they have been fairly significant in the session, and of course this does tie firmly to the geopolitical risks. You had Iranian officials suggesting and threatening a new front of course, in the continuing conflict between Israel and Hamas, pushing up then oil prices. Brent up 2.2%, closing in on $88 a barrel. The moves are also there in the Treasury markets, reversing some, but certainly not all, of the run-up in yields that we saw yesterday. So some money moving in across the Treasury curve. Yields down 5 basis points on the benchmark, 10-year at 4.64, Anna.
Those are the markets. I should alert you to some really interesting conversations coming up on programming today. Later this morning, we'll be speaking to the CEO of the UK's Competition and Markets Authority. This, of course, about the Microsoft Activision deal. We had some news lines around that around 2 hours ago. That's at 9:50 a.m. London time. Plus, plenty more conversations coming to you from the IMF and World Bank meetings. As you've seen, the team fully installed on the ground there, including we'll be speaking to the Governor of the Bank of Italy, the Eurogroup President, Pascal Donohoe, and the Chairman of UniCredit. All of those conversations, as I say, coming through programming this morning for you. That is it for markets today. You can get insights on the UK side of things from the Bloomberg UK website. Click through to the Markets Today blog or go to TLIV Go on the Bloomberg terminal. That is it for this hour. The Pulse is up next. This is Bloomberg.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
We had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua as we continue our special coverage from the IMF World Bank annual meetings here in Marrakesh. Now, coming up on today's program, Israel's army calls for the evacuation of Gaza City within 24 hours. The UN says the order is impossible. Iran warns Israel of a multi-front war if attacks continue. Top U.S. diplomat Antony Blinken continues a whirlwind Middle East trip as Washington and Qatar agreed to hold off distributing $6 billion in Iranian oil revenue. Plus, we're live from the IMF World Bank meetings here in Marrakesh with interviews including the Italian Central Bank Governor Ignazio Visco and the Eurogroup President, Pascal Donoghue. Now let's take a look at the European markets map. I have to say it was a pretty ugly, very intense day when it came to treasuries yesterday. So we look at bonds, but also equities across the board. Global equities are extending a lot of the losses. I think it's only the FTSE over in the UK and maybe part of the Spanish and Portuguese indices that are not extending some of the losses. Again, treasuries gained, crude oil rising as tensions are ratcheting up here in the Middle East. There's continued weakness also. Maybe the data point that was interesting after US CPI yesterday, continued weakness in China's economy. And again, the prospect of these higher for longer US interest rates are adding to the general gloom. Now, on to geopolitics, and Israel has called for an evacuation of more than 1 million civilians living in northern Gaza within the next 24 hours, ahead of what looks like an imminent ground invasion.
The aim here is to minimize the damage to civilians. There are significant combat operations ongoing, and we are preparing for future and the continuance of our combat operations, and out of an understanding that there are civilians here whom are not our enemy and we do not want to target them. We are asking them to evacuate so that we will be able to continue to strike military targets belonging to Hamas in the Gaza Strip.
Let's get more now from Bloomberg's Oliver Crook. He's in Tel Aviv. So, Ollie, what's the latest so far?
So, yeah, Francine, that was the major development of the last few hours, the Israeli military calling for the evacuation of northern Gaza and Gaza City. And you heard it there from the Israeli Defense Forces that they were talking about displacing, more than 1 million people, which the UN says is basically impossible. In a statement, the UN says it considers it impossible for such a movement to take place without devastating humanitarian consequences. The United Nations strongly appeals for any such order to be rescinded, avoiding what could transform what is already a tragedy into a calamitous situation. And the tragedy they're referring to, of course, is the more than 1,500 people that are dead now in Gaza that we understand from the health authorities there. Health authorities that are completely overwhelmed with infrastructure that has completely collapsed, whether it's water, food, electricity, or internet. And that is with Israel continuing strikes overnight, more than 750 targets hit. And of course, all of this in response to the attacks in Israel on Saturday that have left now, we understand, more than 1,300 Israelis dead since Saturday. And again, we step back. The goal of this wartime government, as they've explicitly said, is to crush Hamas. They have more than 300,000 soldiers positioned, ground troops, near Gaza. We do not know if they intend to invade yet on the ground. We have heard from the defense forces that there has not yet been a political decision made. However, all of the ingredients are in place to move into Gaza. The military is at least preparing for this possibility.
Yeah, there are a number of officials from around the world visiting today, but what are we specifically expecting from Secretary Blinken? What is he trying to achieve?
Yeah, Francine, the geopolitics of this internationally are extremely, extremely complex. We have Ursula von der Leyen coming later today. The U.S. Defense Secretary, we understand, has arrived in Tel Aviv. We have foreign ministers coming from all over to Tel Aviv, and Blinken himself going to a number of different countries. So we expect from the sort of Western allies of Israel who come here to echo what Blinken said yesterday, which is a full-throated support of Israel, but also caution about how Israel goes about undertaking Hamas. What Blinken said yesterday, it's so important to take every possible precaution to avoid harming civilians, and that's why we mourn the losses of every single innocent life. And this is all ahead of the possible ground invasion. And Blinken, now we understand, is in Jordan. He will meet with Mahmoud Abbas, the leader of the Palestinian Authority in the West Bank. We understand he will also go to Saudi Arabia. He will also go to Qatar, the UAE, and talk to leaders from all over the regions. And this comes at a time when Hamas today has called for a day of rage across the world, protests across the world, which the Israeli government has warned all Jews and Israelis to stay away from. And of course, also we have the Iranian foreign minister, who we understand is currently right now in Lebanon, potentially
in the Middle East, adding to more uncertainty about the global outlook. Well, I'm now joined by Jason Furman. He's economist and professor at Harvard University, formerly a top economic advisor to President Obama. Thank you for joining us, Jason. It's a week where There are a lot of people here and elsewhere, of course, are looking at what's happening in the Middle East, what's happening between Israel and Hamas, tragic loss of human life. But could it also tip, if it becomes wider, the world economy into a recession?
There is certainly a big risk here. But what's striking so far is the contrast between just the enormity of the tragedy we're seeing unfolding. And if you just looked at financial market data, I don't think you'd know anything had happened. Oil went up $1 since this happened. It's $10 off its high last month. But you did use the right word there, uncertainty. Even if the mean doesn't change, if the variance changes, if you're less certain about the future, that can lead businesses to hold off.
So is this, I mean, is it almost automatically inflationary, or could it be deflationary? Again, if there's less business spending, if consumers suddenly say, I'm really nervous about what's happening, let me stay at home more.
Right. Of course, it could go either way.
Yeah.
If you saw a big increase in the price of oil, yes, that would be inflationary. If you don't see the increase, but you're just worried about that higher variance, not the mean changing, that can reduce activity. Also, fueling some of the divergences we've seen in the global economy. The U.S. will be relatively little affected, but Europe is much more serious in terms of being an oil importer, and also natural gas prices that can go up a lot more than they can in the United States. So expect this to be more of a drag and a risk for the European economy than for the U.S. one, a European economy that already is facing bigger challenges.
So there was also a belief in the markets that actually the Fed may be one more hike and then done. Could this change the trajectory for interest rates? And if we have peak interest rates at a higher level, let's say 6, 6.5, even 7, what does that mean for corporates?
Yeah, I mean, again, I hate to not want to talk about the topic you want to talk about, but the run, if you just care about financial markets, that run up in treasury rates that led a number of Fed speakers, I think, quite wisely to say this is doing some of our work for us. We may not need to hike as much anymore. That's been a big change in financial markets in the last couple of days as the Fed has internalized that message, made it clear that it understands that to markets. I used to think they were going to hike 2 more times. I'm no longer sure that they're going to hike again.
But so, Jesse, we're at this uncertainty, right? So you could have financial conditions tightening, which they have so far. You could also see a reopening with the Chinese consumer coming back, and that would counter-effect maybe some of the tightening financial conditions.
Absolutely. And, normally strength in China is good for the global economy, but it's very differential here. For Europe, they're exporting a lot there, a country like Germany, so strength in China is good for them. For the United States, we've probably benefited from some of the deflation in, for example, the price of oil that in part is due to weakness in China, and we'd lose that benefit if it went the other way.
When you look at the world economy, what worries you the most?
What worries me the most is just this combination of lots of smaller and medium-sized things and not any one thing. I mean, you always, ask me any year, I'm always worried about, Iran and how volatile that situation is and its place in the global economy. Certainly you need to be more worried today than ever before, but I think it's that plus a lot of other things, plus the divergence. It's harder to craft a common response when China, Europe, the United States, all in really quite different situations in terms of growth, inflation, and overall macro trajectory.
There's also huge divisions or splits as we go into the U.S. election, but also it was tricky for Harvard. I don't know whether you describe it like that, and it's done the news certainly on Bloomberg. We had a big story saying how the university dealt with this Israel-Hamas conflict. I mean, have you spent a lot of time thinking about what could have been done, what should have been done, and the role actually of colleges in this?
Yeah, I spent a lot of time on this in the last week. I've spoken to a lot of Israeli and Jewish students. I've spoken to a number of Muslim students too. And there is a horrible war going on 10,000 miles away from our campus. Our students, they all make fun of the same professors, possibly me. They all dislike the same food in the dining halls. Like, if they can't set a model for talking and engaging with each other, I don't know who can. I think part of it is that students who went out and said, basically, this is the original atrocities were not the fault of Hamas and refused to lay moral blame, set a bad tone. but right now it's degenerated. The president of the university, I think, initially some maybe faulty communications, but now I think is doing a great job of providing moral clarity, trying to bring people together, and it won't solve this problem, but maybe we can solve it a little bit better on our own, in our own little pieces of the world.
Jason, thank you so much for your time today. Jason Furman, they're economist and professor at the Harvard Kennedy School of Government. Now, we'll have plenty more from Karen Marrakesh coming up, and this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Increasing signs that a softer landing than we anticipated is possible. So there are risks to that, but there are many signs, and not the same in all countries. So if you look at our footprint, Brazil, Mexico, 3% growth, Spain, probably 1.7, 1.8, so higher than other European countries. US, incredibly resilient, and I think the good news in the US is we're seeing investment by businesses. So it's different depending on the countries, the regions, and also the sectors. So manufacturing suffering much more than services, for example. So again, positive signs that we might get a softer landing than anticipated. That's how I would summarize it.
And do you think interest rates have peaked globally?
That is the million-dollar question. So, to answer the question, you need to understand, and we need to remember, why are we where we are? So we are where we are because we had a massive supply shock, supply side. That is what is putting us at risk of either stagflation or a deeper recession. Central banks, I believe, are committed to staying the course. They need to get down not just inflation, but inflation expectations. The key here is that the fiscal side work alongside monetary policy. And so the fiscal policies working with businesses, we need massive investment. Massive investment means that we need to increase the supply, right? If we only keep on working on the demand side, the supply side is never going to rebalance. And so going back to the big challenge we have, the great challenge of growth, we need to make sure there's investment. Again, the US is doing better than other regions. So I think that is where banks also have a role to play. We have tripled our capital since the financial crisis. We're ready to lend. We need to make sure that governments and regulators understand how banks are essential to rebalance the world economy.
given where interest rates are, when will depositors in Spain actually get more for their money?
So banking is a business where you have two sides to the balance sheet, right? And so depositors, and in the case of Santander, Santander is a retail commercial bank. 80% of our depositors are retail, and the majority of those are very small transactional accounts. So there is a lot of excess liquidity. That means that we will and we are remunerating a lot of our deposits already. But on the other side, because of the lack of demand, and that's an issue in Europe, you know, pricing on mortgages, we're pricing mortgages 30 basis points above the sovereign risk. So super competitive on the asset side, you know, excess liquidity, and that is how the market economy works, right? And so it's rebalancing. We are increasing our remuneration of deposits depending on the market condition and also the demand from customers.
That was the Santander Executive Chairman, Anna Botín, speaking to me here in Marrakesh. Coming up, we speak to Ignazio Visco, the governor of the Italy Central Bank. That's next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He
story.
is there, the kind of upside.
Welcome back to Marrakesh, everyone. Now, the ECB Governing Council member Gabriel Maklouf says Italy's bond yield spread over peers will keep ECB officials on alert. Joining us now is Ignazio Visco. He's governor of the Bank of Italy. Governor, thank you for joining us. We have a lot to talk about. Italian growth, Italian bond spreads is also one of them. What do you say to the Irish central bank governor, who really sounded the alarm yesterday?
You start immediately with a kind of conflict. No, I mean, I don't dare to talk about Ireland, but I can talk about Italy myself. And I think that as far as the recent worries about Italian public debt, they have to be understood a little bit better. First of all, the debt fell 15 percentage points after an increase of 20. 20 due to fight the pandemic risks, which have been fought effectively. There has been a major rebound. The reduction is substantial. The issue here is whether in the plans of the government there is further reduction or not, and how and what are the constraints. My impression is that while fiscal prudence is necessary, so I think that for the next years there is nothing we can do really to increase our fiscal space except a better composition of expenditures. We can grow more. And that is the main reason why I think markets are worried, the ability of the Italian economy to grow.
But Governor, just because of the spread, does it change actually the way that the central bank can also look at PEP going forwards in terms of time frame? Is it?
Well, we had this discussion at the time of risk of fragmentation. And therefore, clearly, risk fragmentation reminds us of what happened in 2011, 2012. I don't think that we are in that realm, really. The differential of the Italian rates with respect to the Germany is relevant, but is far from that. And there are no signs, really, that it should rise really in a territory which would require us to intervene. But if there was a need, I think we can. It has to do with this PEP being maintained. We decided really to keep it until the end of this 2024. I think that's a good approach, also to somehow tranquilize the market. But I don't think that we should really have all this worry and tension now.
But Governor, what do you worry about the most? So you have a complicated geopolitical, of course, backdrop to a possible complicated political also backdrop in Italy.
Well, my main worry is geopolitical. I think uncertainty looms great. And even before this incredible attack by Hamas to Israel, it was already visible. The fragmentation, again, at the world level, the risk of what somebody talks of deglobalization being excessively rapid, strong, and so on, I think were material. And I think that much of the benefits of being open risks to be lost. But being open is not only to have high trade of goods, services, capital exchanges and so on, but also open to ideas, to knowledge, to people. And in the face of dramatic increase still in demographics, I think we have to be very careful on that.
But Governor, does it change actually what the ECB can do? So do you see monetary policy having to do more if inflation picks up because of energy prices, which is now, I guess, a real possibility?
This is a possibility that energy prices, as a result of the risks in the Middle East mostly, rather than the Russian-Ukraine war, may show some developments that were not expected and might be on the wrong side. On the other hand, I don't think that there will be the same kind of risk that we had experienced when gas prices increased, because gas prices increased from 20 euros megawatt hour up to 350, and then now are at 40. So large volatility, but you know the increase was very, very large. That is not the picture that I have. On the other hand, you have to be careful. We are coming out also with our projections today for the Italian economy. And I'm not anticipating that, except saying that we think that the 2% target is still very much in the making.
Governor, you're about to step down. I have 20 seconds. What will you miss the most?
Yes.
What will you miss the most about these meetings?
I'm worried here, really, that the idea is that a closed economy can grow as if it was open.
Okay, well, I'll miss our interviews, actually, once you step down, so you still have to come back on Bloomberg. Governor.
I may.
Thank you so much. That was, of course, Ignazio Visco, the governor of Banca d'Italia. Coming up, Israel has called for an evacuation of all civilians in Gaza City. The latest on the conflict next, and this is Bloomberg.
Say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in, but I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The top names in business are on Bloomberg.
Market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
Israel's army calls for the evacuation of Gaza City within 24 hours, but the UN says the order is impossible. Iran warns Israel of a multi-front war if attacks continue. Top U.S. diplomat Antony Blinken is in Jordan as his whirlwind trip continues across the Middle East. Meanwhile, Washington and Qatar agreed to hold off distributing $6 billion in Iranian oil revenue. Plus, we're live here from the IMF World Bank meetings in Marrakesh. In just a moment, we'll be speaking to the Eurogroup President Pascal Donohoe. We'll also be speaking to Sigrid Kaag very shortly. Now, good morning, everyone. Welcome to The Pulse. I'm, of course, Francine Lacqua with more special coverage from the IMF annual meetings here in Morocco. Now, Israel has called for an evacuation of more than 1 million civilians living in northern Gaza within the next 24 hours, ahead of what looks like an imminent ground invasion. Let's speak to Bloomberg's Oliver Crook in Tel Aviv. So, Ollie, what exactly is the latest this morning?
That's right, Francine. That is the major development here. The Israeli Defense Forces telling the north of Gaza, Gaza City, to evacuate and to move to the south. This is displacing more than 1 million people is what we're talking about. The UN says that this is virtually impossible. What the UN has said is that it's strongly appealing for any such order to be rescinded, avoiding what could transform what is already a tragedy into a calamitous situation. And the tragedy they're referring to are the already 1,500 dead, at least in Gaza. There were more operations overnight. There's no electricity, water, food. I mean, of course, this is the response to the attacks in Israel that has left, as we understand today, more than 1,300 Israelis dead. There has not yet been a decision made on whether or not there will be a land invasion. However, there are 300,000 Israeli troops that are ready, that are stationed near Gaza in case they want to move forward. Now, we await Ursula von der Leyen arriving today in Israel with a number of other emissaries. And Antony Blinken, as you mentioned, meeting with Mahmoud Abbas, the leader of the Palestinian administrative in the West Bank, but he will also go to Egypt. He will go to Saudi Arabia. He will go to the UAE. And you can bet absolutely top of the agenda there will be the spillover effect. Just as in Israel, all of these images of horror were being fed to the citizens on social media, you have the same exact phenomenon happening across the Arab world right now. You have protests today, right now, on the streets of Iraq. You have also the Iranian foreign minister in Lebanon right now, we understand, meeting with Hezbollah leadership. So this has huge potential for escalation, and this is going to be top of the agenda for the U.S. Secretary of State as he goes around the Middle East.
Oliver, thank you so much. Bloomberg's Oliver Crook there in Tel Aviv. Now, the Netherlands heads to the polls also next month, with EU debt and deficit ratios becoming surprisingly big issues for voters. Joining us now is Sigrid Kaag, the Deputy Prime Minister and Minister of Finance for the Netherlands. Thank you, Minister, for joining us. It's a heavy week because of the tragic loss of human life on both sides. And I wonder whether, as finance ministers gather here in Marrakesh, a lot of the talk is actually what this also means for the world economy, for divisions in societies that are already extremely, extremely divided.
No, and that's the surreal part of it. And I'm saying this also as a former humanitarian. As the Netherlands, of course, we've strongly condemned the terror attack by Hamas that resulted in the loss of innocent Israeli lives. We're also concerned on the loss of the side of innocent Palestinian lives, citizens in Gaza. So I think we're all deeply concerned, and yet in Marrakesh, we're talking geoeconomics, geopolitics, so specific issues, I would not say are the dominant theme, but it's in the back of everyone's mind, that we realize how uncertain the world is, that we need to invest in peace and security, we need to focus on stability, but it's very fragile in an already fragmented world.
But Minister, is that because it's almost impossible actually to know where this goes next, what happens next?
So in many world stages it is very difficult. Of course, if we zoom into the particular situation now, Tel Aviv, Gaza, I haven't heard your reporter, so I'm also not going to comment, but I think we're all concerned. We stand by Israel's right to self-defense, equally so in line with international humanitarian law and issues of proportionality, which always have to be respected. It's a very tough call, and I'm really hopeful that Antony Blinken will be able to speak to all, and hopefully we can avert a further worsening situation, but no one can tell. Would this impact the geoeconomic outlook? I'm not entirely sure, but it reinforces a sense of insecurity, unpredictability in a world where already we're slower to recover from Corona, the impact of the Ukraine crisis, a war that is still going on, without prospects of an easy resolve. Hence, these are the factors we have to deal with. And as you said, in the Netherlands, for instance, voters are looking at their purchasing power, high interest rates, inflation, which is coming down, but not as low as people got used to. So these are all issues that become domestic, and ultimately most politics is domestic, at least in a country such as the Netherlands. So it will be around security of living, expenditures, and the investments required to make the Netherlands fit for the future.
So, Minister, you will step down. You've just said that you'll step down, but actually you're staying as caretaker.
Correct.
Where do you see the politics of the Netherlands actually going from here? What will happen?
Well, I stepped down as a party leader, and I announced I would not continue in Dutch national politics at the request of my family. I've been sort of one of the most favored target of extreme right wing. Now, that doesn't faze me so much. I've worked and lived in war zones to advance peace and security. But my family was deeply troubled by the dehumanization, the demonization, particularly as female political leaders. And I felt I had served my country honorably for 6 years. There's a time to come and there's a time to go and to spread your wings. But the essence is polarization. The essence is extreme voices, threats, hate, intimidation, and death threats. And that cannot be healthy to a democracy, let alone for political parties and all of us to uphold the rule of law. It has a negative impact on society. So politicians need to continue to relate, to bridge, exude respect, but also engage in norm setting. That needs to happen in the Netherlands, and it needs to happen in other European countries.
What do you think will change that, if anything?
I'm not sure. I'm hopeful that there is a new generation, there is a shift, there's a tidal wave coming. And voters also have expressed, citizens are saying, enough is enough, this is not my country. I do not want to demonize the other. I want politicians and those in public service to deliver services for me, to render my life better and to help us build a better future in the Netherlands, with Europe, and also internationally, where we can play our part. But that's a tough call, and it needs people to straighten their backs and continue to follow their moral compass.
Minister, I also need to ask you about a couple of companies that, of course, are on the block, on the sale block, actually, for the Netherlands. What's the update on Tenet Holding? Are you nearing the sale?
That would be an unwise reflection of mine at all. The negotiations are ongoing.
Is there anything else? I mean, one of the other things is, you know, you have been cutting the stake, or the Dutch government has been cutting the stake of ABN AMRO. What's the ideal way of moving this forward?
Well, again, there we don't comment publicly on what the sort of the positioning is. We have indeed cut out the share of the state to below the 50%. That was always the target. It hadn't achieved for a long time, but that we do in sort of the confidentiality and in line with sort of market regulations that we have.
What will you do next?
I don't know, and that's sort of interesting and exciting. I certainly want to be out there internationally again. I've always had an international outlook and experience, and I'm hopeful and interested to see what may come my way. And if it doesn't, something else I'll have to create.
Is it daunting at all, or is...
Yes and no. I mean, I have 35 years of work experience, so I should have the comfort of that. And it's always daunting to start something new, but I've often done that. Different roles, different countries, different organizations or assignments. So I'm also actually sort of looking forward to the unknown. I just hope it's going to be safe and good.
Me too. Thank you so much for joining us today. Sigrid Kaag, there, the Deputy Prime Minister and Minister of Finance of the Netherlands. Now, we'll have plenty more, of course, right here from the IMF World Bank meetings. The IMF cutting growth forecast to the euro area, warning of stubborn inflation and weak global growth in 2024. We'll discuss much more of that with the Eurogroup President, Pascal Donoghue. That's coming up next, and this is Bloomberg.
was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero!
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
European Commission President Ursula von der Leyen and European Parliament President Roberta Metsola will visit Israel today to meet with the country's leaders. Now, this, of course, in the week that the IMF cut its growth forecast for the euro area, warning of a stubborn inflation and weak global growth in 2024. Now, we're pleased to be joined by the Eurogroup President, Pascal Donahue. Pascal, as always, thank you so much for joining us. It's a tough week because we look at geopolitics and it's not really filtering through a lot of the conversations here because that's focused on the macroeconomy. And frankly, is it just impossible to say what risks we'll be facing because of the renewed conflict?
Indeed, and the recent tragic events in the Middle East remind us of the era that we are in, of unpredictable historic events taking place that can change so quickly the economic context that we're in. And while, of course, we're here appropriately talking about economics and what it means for jobs and income, of course, I'm so conscious of the suffering, the lives lost, and the great trauma that many are enduring at the moment, both in the Middle East and, of course, Ukraine. But we are indeed in an era of unpredictability, which makes economic choices all the more important.
But what does that mean for possible volatility? Again, we don't know what happens with this conflict. This is after also a number of shocks because of what's happening in Ukraine, because of COVID. Yeah. So how difficult is it even to set policy?
Well, I continue to be positive about the ability of the euro area and the European Union to be stable and to be resilient in an atmosphere where the frequency of shocks and their impact very much appears to be in line with other historical periods where very big events happened with great frequency with unpredictable consequences. But if I look at how we have navigated our way through the pandemic, and if I look at the continued employment resilience of the euro area, I am not at all complacent, but I still believe the foundations are in place for us to be stable within the euro area and for us to respond to these challenges. But of course, the most important economic issue will be what, in fact, the latest developments have on inflation.
But do you think the euro area can actually avoid a recession?
Yes, I do. I think the most likely scenario at the moment is still one of lower growth. As you correctly identified a moment ago, the IMF have changed the growth outlook for the euro area. That change in the growth outlook for me is very understandable in the context of the scale of conflict that is taking place within Europe at the moment. But even with that change in the growth forecast, it's still a forecast of growth. And critically, from a social cohesion perspective, we're still seeing very high levels of employment. And I think that is a vital political factor in dealing with all of these challenges.
I think Janet Yellen, Secretary Yellen, is actually coming to the euro area.
Yes, we are.
Meetings on Monday.
She is indeed.
What will you discuss?
Well, we're very much looking forward to welcoming Secretary Yellen to the Eurogroup. We have now made this nearly an annual event where we invite the Secretary to meet all ministers collectively. And the themes of our discussion will be our shared efforts with regard to inflation, our cooperation now with regard to Ukraine and the importance of that. And then, of course, there'll be many other economic issues that will be discussed, including the interplay between the Inflation Reduction Act and the various national recovery and reform plans that are underway within the European Union in the aftermath of COVID, which of course is funded by a new form of public debt.
I was going to ask you about the Inflation Reduction Act. A lot of people were angry that the US were putting such a thing in place. Is there going to be a more robust European response?
Well, there's been a lot of robust European discussion in relation to it. And for me, the response is what we're already doing, which is the implementation of the recovery plans that were put in place in the aftermath of the pandemic. That involves spending hundreds of billions of euros in the kind of sectors that Europe and America have now identified to be really, really important. And then we're also looking at some very limited changes within the single market framework to help particular countries and all countries still be competitive. And I think that's the space that we should be in. I mean, the good thing is, at least we're all looking at the parts of our economy, the green parts of our economy and the digital parts of our economy that have the potential to deliver public goods in the future.
Critics say that the new 2024 Irish budget will fuel inflation. Would you respond to them?
So if you look at the 2024 budget, which we just did on Tuesday, so it's been a busy week, that actually is looking to reduce the fiscal stimulus in our economy across next year. We did our budget a year ago, and then we added to that budget with many other economic decisions that we took within this year. And we're looking to move away from that. We've reduced the value of our subsidies to households and to businesses by between a quarter and a fifth. And if we now deliver these spending plans next year, which the government will do, it will reduce by quite a bit the degree of fiscal stimulus within our economy. Now, is there an inflation risk? The truth is there's risks everywhere at the moment. But if we didn't act, there's also a risk of many, many households in Ireland becoming a lot poorer. And it's about trying to get that balance right, which I believe we have. But we're reducing our supports.
Minister, how difficult actually is it to get that balance right across the euro area?
Yeah.
Because it's also swelling debt, but at the same time you still have to, in a lot of parts, take care of the most vulnerable.
It's a real balance, and a balance that we have to attain. Within Ireland, it has a very different context because we have a budget surplus in Ireland. We're going to move in 2024 into a third year of running quite a significant surplus. So, of course, that makes it a very difficult, even very different political discussion because the money is there to spend. And we are deciding not to spend that surplus because we don't want to add to inflation. In relation to your further point there about the euro area, this is why we are saying that we shouldn't be withdrawing subsidies entirely or withdrawing energy support plans entirely, but we need to work a bit harder to give the support to those who need it the most. But that's not easy because even technically it can be very hard to do to come up with the programs that can make that happen.
How much do you worry about the commercial property sector?
Well, if I look at it within Ireland, the commercial real estate risks that we have are no different to any other country that has a big capital city within it, that has a lot of big employers in it. I think it is a risk. What I think is more likely to happen, though, is I think we're likely to see a very different use of commercial property in the years ahead. I think it's going to move away from us all sitting beside each other, looking at computer screens, not talking to each other, into more creative and meeting areas.
That will be
Maybe
very
that's
welcome.
a slight note of optimism to end there.
That will be welcome. Thank you so much.
Thank you.
Pascal Donoghue there, the president of the Eurogroup. We'll have plenty more, of course, from Marrakesh. This is Bloomberg.
was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Welcome back to The Pulse. I'm Kriti Gupta in London. Microsoft's $69 billion takeover of Activision Blizzard has been approved by the UK competition watchdog. The CMA says that Microsoft's restructured offer to sell some gaming rights to French publisher Ubisoft satisfied the competition concerns it had. Let's bring in the CEO of the UK Competition and Markets Authority, Sarah Cardell, joins me live on the program. Sarah, congratulations to you and to your team for finally getting this across the finish line. What struck out to me in your announcement this morning is that you still had limited residual concerns around pieces of the deal. Can you elaborate on that?
So in our previous consultation that we put out a couple of weeks ago, we made clear that the deal had resolved the substantial concerns that we had previously, and that's because Microsoft have brought forward this fundamental concession, this fundamental restructure of the deal, which now puts all of the cloud streaming rights in relation to Activision's games content, all of the games that are available now, but also any content that's created over the next 15 years. And those rights are put in the hands of Ubisoft, an independent competitor. And that breaks the stranglehold that we were concerned Microsoft would have over this important cloud gaming sector as it develops and emerges. Now, we had some residual concerns at the time just to make sure that the terms of that arrangement with Ubisoft were absolutely watertight. We had a short consultation, and as a result of that, we've satisfied ourselves that those concerns are resolved, and therefore this new restructured deal is clear to proceed today.
A sigh of relief, I'm sure, on the Microsoft side, as well as for a lot of tech companies broadly. Sarah, while I have you, though, I'm curious about how some of this experience applies to some of the other tech deals that are on your docket. I'm looking at, for example, the Adobe Figma merger, which is under quite a bit of scrutiny as well, not just from you, but from your peers around the world as well, in addition to the latest probe that I believe Ofcom recommended to the CMA when it comes to cloud computing in the country. Walk us through the updates on those two investigations.
So those investigations are both live, as you say. The Adobe Figma investigation is sort of fairly well evolved through our process, but that's being investigated by an independent group, as the case with all of our phase 2 merger investigations. So it's not really appropriate for me to comment further on that deal at this stage. Likewise, our new investigation into cloud infrastructure services has just started. This is an important investigation, but it's running to an 18-month timetable, so it'll be some time before we come through with our initial views on that. But what I would say is a common theme through all of this work is that the CMA has a real responsibility to make sure that all of these digital markets are open, are running effective competition in conditions where choice and innovation can really thrive, where new competitors are able to come into the market and grow. And that is important because it benefits both consumers and businesses who are trying to compete in those markets. So that is a responsibility that we have, whatever deal we're looking at, and we take that responsibility very seriously.
I'm glad to hear you say that. And very quickly, Sarah, some of your critics have compared the CMA to how the European Commission operates, saying that perhaps the CMA is more rigid and less willing to negotiate and work with the authorities as opposed to, say, the European Commission or arguably even the American authorities as well. What would you say to that? Is this going to change your approach to those mergers? We have about 40 seconds left.
So we've been really clear that it's for the parties to resolve our concerns. Microsoft eventually came forward with a major concession that was a real game changer, but they took far too long to do that. So my message is, if parties want to resolve their concerns, come forward quickly and fully in an effort to do that, and then we will engage constructively in those discussions.
And you'll engage from the beginning. Is that right, Sarah? Yes or no?
Well, the sooner they come forward, the sooner we can engage, but it needs to be a genuine, sincere attempt to resolve our concerns.
Understood. Sarah Cardell, the CEO of the Competition Markets Authority, we thank you so much for joining us this morning. Plenty more to bring you from the IMF as well, including an exclusive interview with UniCredit Chairman Pietro Carlo Padoan coming up just after 10:10 a.m. London time. Stick with us. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Israel Army calls for an evacuation of Gaza City within 24 hours, signaling a ground operation could be coming soon. Elsewhere, top U.S. diplomat Antony Blinken continues his whirlwind trip across the Middle East. The U.S. government bond market has had its worst day since March 2020 by one measure. Fed official Susan Collins says the recent run-up in Treasury yields could reduce the need for hikes.
The rise in long-term yields implies some tightening of financial conditions, and if it persists, it likely reduces the need for further monetary policy tightening in the near term.
And Representative Steve Scalise pulls out of the race for the U.S. House Speaker, this prolonging the House's inability to address an approaching fiscal deadline and complicates potential aid packages for Israel. A very good morning. We got to Friday and the equity market took a little bit of a smack yesterday on that peak rate narrative, perhaps being disemboweled slightly by the hotter CPI. But you can see this morning we've managed to put on a little bit of a pip on the upside. It was a tawdry auction. Danny will take you through that. And that was really the spark for higher yields and lower cash equities. This morning, what you've got is a note from Bank of America saying you can avoid the worst case scenario so long as rates remain below 5%. That's the critically important point for Bank of America. By the way, the best trade for them in 2024 is a recession and rate cuts, and then you want to be long bonds and long off a couple of other commodities. Now, when it comes to MSCI All World, so you've had some attempts by China this week to come in with a little bit of sustenance. We're now hearing that they may bolster the equity market a little bit more, but that's doing very little on the Asian side because you've got near deflation. You've got a flat CPI in China. When it comes to Europe, what you've got here is oil. Danny will take you through that in a moment. The stock 600 is down by 0.4%. So yes, it's a little bit lighter on its feet today, but oil is up, and it's those oil stocks that are perhaps doing the best. The energy components are big. BP and Shell at the bottom of your screen are doing quite nicely. So the underbelly of what's going on in the stock 600, Danny, is interesting if you leave that top line aside.
Yeah, well, I should probably start there then, man. It's a great tee-up. Brent crude up nearly 3%. It's on track for a weekly gain. There's been a lot going on, a lot of volatility in this oil market, and the fear is escalation. It continues to be the Iranian involvement. We did have the foreign minister of Iran saying, should the Tehran-backed militants, they might need to open up a new front if the blockade of Gaza continues. Bloomberg Economics figures it would add up to oil of $150 should we get that type of escalation. But the drama pandemic type sell-off. There is some buying this morning. We're up about 5 basis points, but it hasn't completely erased that fear. I'll take you through the moves in just a moment. Meanwhile, speaking of the fear of escalation, gold has gotten a really solid bid this week. It's up another 0.8% today, set for its best week in 7 months. But Manus, I think it's worth taking a pause and looking at the movement of the 30-year yield yesterday because it was quite remarkable. For our radio listening audience, I have a very simple intraday chart. You can see around 1:30 my time, of course, earlier in New York, you get this move up. When it came to the CPI, you had hotter rents, hotter shelter inflation. The super core is also hotter, led by things like wage inflation. And then this line that I have on the chart here, Manus, it's that really bad 30-year auction, the highest award since 2007. That's what really lifts this thing up. 16 basis points higher is where we ended. We're trading just at that level, just below that level of where the auction was. So for the most part, Manus, we are holding on to the losses from the bond market that we saw yesterday.
And this is the destabilization that I was referring to, Danny. In other words, we were shook by that slightly hotter print on the CPI, but the narrative from that long end of the curve has really destabilized. I'm surprised stocks didn't take a bigger bath. And when it comes to whether you should step in on these spiking years, I really like what Richard Bernstein advisors are saying. I don't think now is the time to play the hero and to add a ton of duration. But it takes us back 24 hours ago when we had T.S. Lombard here in the studio talking about the pernicious reinvention of inflation. That is the risk in those bond markets. Danny?
Totally what happened yesterday.
Okay, we're trying to understand the global ramifications of what's going on in Israel. They have called as a nation for an evacuation of all civilians in Gaza City and told United Nations to move its staff away from the area.
The aim here is to minimize the damage to civilians. There are significant combat operations ongoing, and we are preparing for future and the continuance of our combat operations, and out of an understanding that there are civilians here whom are not our enemy and we do not want to target them. We are asking them to evacuate so that we will be able to continue to strike military targets belonging to Hamas in the Gaza Strip.
Just how logistically possible is this? Oliver Krug is in Tel Aviv for us. Oliver, the very latest, the UN has made it clear that the logistics of what's being requested are perhaps insurmountable. Good morning.
That's right, Manus. That is the big development overnight. Israel urging that the evacuation of Gaza City in the north of Gaza down to the south because of their continuing military operations, and saying that they want to reduce the civilian casualties, civilians which they say Hamas uses as human shields. So they're talking about evacuating more than 1 million people. The United Nations says that this is basically impossible. This is what the UN had to say. They strongly appeal for any such order to be rescinded, avoiding what could transform what is already a tragedy into a calamitous situation. That tragedy is more than 1,500 people dead in Gaza, according to the health authorities, which are completely overwhelmed with infrastructure in complete shambles, electricity, food, water, internet, all down. The Israeli Defense Force struck another 750 targets overnight, and this, of course, all in response to the, now we understand, 1,300 Israelis that are dead since the attacks on Saturdays, mostly died on Saturday, and mostly civilians.
Oliver, given the calls to evacuate Gaza, what is the status and likelihood of a possible ground invasion?
So we know that the ambition of the new wartime government is to crush Hamas. The question is, how do they intend to do it? We also know that there are 300,000 ground troops stationed near Gaza, and we don't know whether or not they will move in. The Defense Forces have said the political leadership has not yet made that determination. However, all of the ingredients are in place for a land invasion, and that can come at a huge cost for both Israeli forces, but also for civilians in Gaza. And it opens up a whole slew of questions about how would you go about this? How do you operate within this territory? At what cost? And also critically, what is the long-term strategy?
Oliver, international politics of this are complex. We saw Blinken arrive yesterday, but his trip will be extended. He's in the region. He met a number of officials. I mean, just put some context around the trip to Israel and what happens next.
That's right, Manus. And we have Ursula von der Leyen coming to Tel Aviv today. We have the U.S. Defense Secretary in Tel Aviv and a lot of different emissaries. All of the allies of Israel will probably echo the same points that Blinken made yesterday, which is one of A, total support, but two, it is very important about how Israel goes about their attack on Hamas. What he says is it's so important to take every possible precaution to avoid harming civilians, and that's why we mourn the loss of every innocent life. And he will take that message as he meets with Mahmoud Abbas, the president of the Palestinian Authority in the West Bank, but he's going to Saudi Arabia, the UAE, Egypt, Qatar, and number one on the agenda, you have to imagine, or very close to it, is going to be the possibility of spillover. Just as in Israel, you had the population here being fed all of these horrifying images over the weekend on social media, you have the exact same thing happening in the Arab world with what's going on in Gaza. And today you have protests on the streets of Iraq where people are very, very inflamed. Hamas has called for a day of rage across the world today. And Iran has warned that they could open, the second front could open in this war in Israel. And we understand the Iranian foreign minister is in Lebanon. And we understand that he is meeting with the leadership of Hezbollah. So these Arab leaders will also come under intense pressure from their populations, and it could also be a threat to the political stability in these countries.
Indeed. Oliver, thank you so much. That's Bloomberg's Oliver Crook reporting live from Tel Aviv. Now, to the Fed, where officials are grappling with a run-up in bond yields since they last met in September. Here's what we've heard from Fed officials just this week.
If term premiums rise, they could do some of the work of cooling the economy for us, leaving less need for additional monetary policy tightening to achieve the FOMC's objectives.
Whether it unravels or whether the momentum in the economy changes, that could be equivalent to another rate hike.
I actually don't think we need to increase rates anymore.
Important thing to note there is that that allows us a little bit of patience that we can continue to watch as economic conditions and financial conditions continue to evolve.
I think current policy is restrictive and putting downward pressure on the inflation rate. And that's really what my concern is.
We're likely very near and perhaps at the peak for this tightening cycle.
Maybe we can get inflation all the way back down and avoiding a deep recession. That's what I would call a soft landing. So far, it's looking more favorable.
Some very similar comments across the Fed of the market doing the work for us. Maybe we're near the end. That sent bonds rallying, but then, of course, they were slapped in the face yesterday by a hot CPI print and a poor auction. Joining us now to talk about all of it is Bloomberg Markets Live editor Eddie Vanderwalt. Eddie, first of all, I wonder if CPI took into the account that Manus just had to rent an apartment in New York. I think that's probably why that figure was up a lot more. But how much of a turnaround is this from what we've seen from Fed speak, from really the rest of the week?
Yeah, I'll believe that was solely his influence, right? But look, you're right. The debate at the Fed seems to be at the moment around the idea of do longer end yields affect the people's ability to borrow? Does it tighten conditions enough to affect inflation? Markets Live had a look at some of this data earlier in the week, and the coincident impact on inflation seems to be very limited, but the lagged effect seems to be bigger. And I think that is something that you have to accept. You don't know in the moment whether it's going to impact now, but the Fed is definitely talking about this. And as we see those 30-year yields rising further, that's going to be a continuing debate, particularly if we get 10-year yields near 5%. I think people are going to be talking about this more and more.
And that's what Bank of America are talking about. They say the equity market can hold up and avoid a complete bloodbath so long as yields don't break that 5% level. But I want to go back to that parabolic move at the long end of the curve, the 30-year paper that Danny showed, which was, it was exponential, wasn't it, at the end of the day in the auction. Now, that says one of two things to me. Either you have the hallmarks of a buyer's strike, or certainly, as Bernstein say, now is the time not to be a hero. Where do you come down in that argument?
Yeah, it's very difficult, right? On the one hand, there are a lot of reasons for caution out there. Investors want protection. There is a lot of haven demand, and we're seeing that, for instance, in the rally in gold prices. But at the same time, do you really want to be owning bonds if what looks like at the moment a fairly robust U.S. economy at the same time as inflation staying well above expectations, right? The CPI reading yesterday should be worrying for investors in those longer-term bonds because, at some point we are going to get a yield curve that is no longer inverted. And at the moment, it looks like all of that steepening is going to come via the long end because it seems like the debate has shifted from how high the Fed's going to push rates to how long they're going to keep them there. And I think that's where we are right now.
Now, elsewhere in China, it's the second day in a row we've had signs that the home team is coming to defend things. Yesterday was about banking stocks. Today, it's that scoop of considering a state-backed stabilization fund. I'm looking, though, at China markets, China equities, still down. Hong Kong is down nearly 2%. Why is the market not taking this, not absorbing this and rallying off the back of it?
Yeah, absolutely. Look, I think there is this idea that if this is a stabilization fund, then that means we're going to protect downside. It doesn't mean we're going to push prices higher. At the same time, does equity stability feed through into the rest of the economy, right? You don't solve youth employment by driving stock prices higher. But I will say that, stocks feed through into the rest of the economy because it builds confidence. And I think that is the play here. China wants to build confidence without unleashing a big, stimulus project. And I think this is part of that broader package that they want to unleash.
Yeah, a really good point. Eddie, thank you so much for joining us. Eddie Vanderwalt there. And for more analysis from Eddie and the team, MLive Go is where you want to head on your terminal. All right, let's get you some other top stories, what you need to know trending on the terminal this morning. Representative Steve Scalise has abandoned his short-lived campaign to become House Speaker following days of contentious meetings among fellow Republicans. That move complicates President Biden's ability to respond to the Middle East war, as the House can't conduct business or approve new aid to Israel until a new speaker is in place. The president had planned to make a formal request for more assistance next week.
Well, Ford says its offer of 23% pay rise to the UAW is the best that it can do, and that going any higher would hurt the company. UAW escalated its near-month-old strike by walking out of Ford's largest plant late yesterday when the auto worker failed to sweeten its economic proposal. Ford contends it has nothing left to give. Danny.
Microsoft's $69 billion takeover of Activision Blizzard has been approved by the UK competition watchdog. The CMA says that Microsoft's restructured offer to sell some gaming rights to French publisher Ubisoft satisfied the competition concerns it had. The agency says it would preserve competition prices and better services, Manus.
Well, coming up, we're live to the IMF meetings in Morocco. Up next, an exclusive interview with UniCredit's chairman, and later this hour, we'll hear from a member of the ECB Governing Council right here on Bloomberg. We also catch up. We talk U.S. banks. Yes, it is Banks Day. The investor Walter Todd joins us from Greenwood Capital as JP Morgan, Citi, Wells Fargo hit the tape this morning right here on Bloomberg.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Last week's events, horrific events, which we have all seen, did not really have a material impact yet on the economy. But this is exactly the dangerous part, because it only needs one or another event, and you see actually a huge or a bigger impact on the markets. What does it mean? We need to stay vigilant. We need to stay diligent. I think our clients really need the advice to risk manage their positions, and that's where we are here.
Deutsche Bank CEO Christian Sewing there, speaking exclusively to Bloomberg's Francine Lacqua earlier at the IMF meetings. And let's go back there to Morocco, live with Francine, where she's standing by with UniCredit's chairman. Francine.
Thank you so much, and good morning to both of you. I'm delighted to be speaking to the UniCredit chairman, Pier Carlo Paduan. Thank you for joining us. There's quite a lot going on. There's a lot going on. Yesterday, we also heard from the central bank governor of Ireland, who was talking about being worried that Italian spreads compared to their peers could hurt Europe. What does it mean for a bank like UniCredit?
Well, it means that we know that interest rates have to be watched very carefully. They depend on trustworthiness. They depend on the economy doing its job, the private sector investing and supporting the activity of many strong Italian companies.
Are you worried that actually Italy will become the sick man of Europe?
No, I'm not worried about becoming the sick man, being a citizen of a sick man of Europe, but because I know that Italy can, and it's done so in the past, can react very forcefully. And it's actually reacting more than what markets seem to understand in terms of potential growth going forward. Yeah. If, and this will be the case, Italy complies with the next generation EU requirements, which means public investment and reforms, this will boost growth, and this is the main recipe for getting out of trouble.
But what does that mean again going forward? If you think the markets don't understand what Italy's going through, is it a problem of the markets or a problem of Italy?
No, it's a problem of showing the markets that that the effort translates into results, and if they recognize that is value making for them, they will support by investing in Italy. This is what will be the sign that things have turned around, and I'm confident Italy has all the potential to achieve that.
I mean, I think Fitch also warned in a note this week that actually Italy is significantly loosening its fiscal plans. The Bank of Italy also saying that governments need to be more cautious in its spending plan. Do you worry about this?
Well, here I can just take note of the fact that the government is about to present its budget law, which recognizes that growth is a bit weaker than expected and public finance is a bit too expansionary than expected. However, that can be adjusted, and especially can be adjusted if there is a medium-term perspective that supports that decision.
What's your biggest concern, actually, regarding countries in general in Europe? You're a former finance minister, so is it how you deal with that in this juncture in time? A lot of households still need support, but inflation, if it goes higher, it means interest rates go higher. It seems that we're a bit at crossroads.
Certainly we're at crossroads, and all variables move in one direction, which is increased fragility. But you can tell the story the other way, and you can say if growth materializes, which is the case, interest rates are now higher than before, but they might stop there. So if you have this combination, that will become more sustainable, and the country will stop making problems to the others and benefit its own. So I repeat, I am confident.
So where are you confident mostly in Italy? When you look at, I guess, some of your loans, some of credit card spending and things like that, how do you see the Italian economy evolving?
The Italian economy is evolving, building on the strong points that were accumulated during the crisis, paradoxically. I'm thinking about deposits. I'm thinking about companies that can invest even without asking loans. I shouldn't say this being a banker, but that's an important positive fact. I'm confident about the banks that 10 years ago were in a much more fragile situation. Now they're much safer and prepared to support the economy. I'm confident also about the fact that the government will eventually bring the budget law at home in a prudent fashion.
So certainly the tax on Italian banks took a lot of investors by surprise. Is there a long-lasting damage to the Italian government's credibility on how they deal with the banks in the eyes of international investors?
Well, I think that the government has analyzed this episode. One should distinguish the content of the proposal that was then put on the table, then it was taken back, with respect to the way it was communicated. I think this second element was the most damaging piece of the story.
Is there something that you think the government should now be focusing on to help the economy?
Well, the government should accelerate the implementation of the National Recovery and Resilience Program, because that will not only produce more public investment, but will push private investment, and therefore This is where the financial system should come in and support financing of investment, which the companies might want to use to increase their programs, their investment projects.
Do you think there's an Italian discount on the stock market for any Italian company?
Well, this has been the case in the past. It might be the case now. However, it's early talk. We still need to see what comes out of the budget document, which will be crucially designed to stabilize once again the economy, and whether, as I said, there is a response to the Next Generation EU program, which is, by the way, very rich in terms of endowment of resources.
We're, of course, talking geopolitics, the uncertainty of geopolitics, what that means for the price of oil, if there's a significant escalation in what we're seeing between Israel and Hamas. Again, what does that mean for the world economy? How do you view it also through the lens of the bank?
I view it as a tremendous shock, which goes beyond, of course, the material costs, and threatens the way the governance of the system has gone for decades after World War II. So it must be managed. And this is about diplomacy, politics, and policy, and values, even before then economics. As far as the implication for the economy, especially the energy market, yes, this is a concern, but this is a concern which can be dealt with by looking at short-term implications for the energy market, but also long-term needs in terms of funding alternative ways of finding energy.
Mr. Padoan, thank you so much for joining us. That was the chair of UniCredit. Manis?
Francine, thank you. Fascinating conversation. And just to end there, Danny, Francine, we'll see more from Morocco. There's the oil prices. We've had a bit of a spike today as we close out the week.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back to Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Israel's army calls for the evacuation of Gaza City within 24 hours, signaling a ground invasion operation could be coming soon. Elsewhere, top U.S. diplomat Anthony Blinken continues his whirlwind trip across the Middle East. And the U.S. government bond market has its worst day since March 2020 by one measure. Fed official Susan Collins says the recent run-up in Treasury yields could reduce the need for hikes. And Representative Steve Scalise pulls out of the race for U.S. House Speaker. The move prolongs the House's inability to address an approaching fiscal deadline and complicates the potential aid packages for Israel. Now, was the CPI data yesterday? Rents came in hotter, Supercore came in hotter, and a very bad auction for the 30-year tripped up bonds yesterday. You had the worst sell-off for the 30-year yield since March 2020. We come back this morning. There is some buying in the early hours of the U.S. session. Down by 5 basis points is where we stand for the 10-year yield. Brent crude, Manus, you and I will talk about this more in just a moment. We're now up 3%. This is a very rare move for this time of the morning. We're gaining steam. We're back up above that level from where we started on Friday. Of course, the spike up from the invasion and went down. Now we're back up. And gold, Manus, very much so related. It is this haven bid, up nearly 1% for the best week for the precious metal in 7 months.
Well, that drop of 5 basis points that you've given us on the bond market gives some sucker to the equity market, because that peak rates party, which was really taking hold, got a bit of a smack yesterday. And then you come in this morning, we've actually turned lower in the past 30 minutes. So we have shifted direction. That tawdry auction yesterday really damaged sentiment. Bank of America have a big note out this morning. They say you can avoid dropping below 4,200 so long as rates below 5%. That is the key narrative for them. When it comes to the global market sentiment, what you have is, of course, China, day two. We're now speculating that they may come in with some kind of a stabilization fund. Yesterday was about buying the banks, but global equities are now much more acutely attuned to the global risk which comes from Israel-Hamas war. If I look at what's happening in terms of our markets here in the US, it's going to be about JP Morgan, it's going to be about Wells Fargo, it's going to be about those banks which come out later on. The underbelly of Europe is interesting. We come down by 0.7%, but because of that spike in oil, and we'll deal with that in just a moment, you are seeing the likes of BP and Shell doing really, really well on that pop higher in the oil market. But sentiment today, ultimately, Danny, will be driven by what is delivered back over here in the US. JP Morgan, Wells Fargo, Goldman Sachs, over the next couple of days are going to define the next move in perhaps these equity markets as we look at the losses they may take. But wow, look at that oil market this morning. That is spiking. That's piping hot. That's what I would say to you. And the question here, Danny, is, of course, it's about contagion. Bloomberg Economics have run the numbers. If there's a spillover from Israel into Iran and an escalation there, Danny, Ziadud and the team say you could look at something like $150 on this oil spike. Danny.
And there's this sense, Manus, that perhaps the market went too quick to unwind the escalation risk. By Wednesday, we were back where we started on Friday. Just to catch everyone up with the latest when it comes out of Israel, the foreign minister of Iran did warn that Tehran-backed militants could open up a new front if the blockade of Gaza continues. It's that risk, Manus, that is very real. Now, while we try to wrap our heads around that, the other story we need to digest, we need to understand, starting today and throughout next week, is U.S. bank earnings. It will kick off this morning. We have JP Morgan, Wells Fargo, and Citi all set to report results before the market opens. Joining us now is Walter Todd, President and CIO of Greenwood Capital, which owns shares of JP Morgan, Wells Fargo, and Bank of America, and Morgan Stanley. Walter, really great to see you. Now, I know you went underweight on the banking sector in the first half of 2022, and I've asked you this question basically every quarter since then, so I'm going to ask it again. Is there anything you could see this earnings season that would make you go overweight?
Yeah, well, good morning. Well, not right now. I just think it's going to be a very, continue to be a challenging environment for banks as long as rates stay where they are. So you're seeing this deposit runoff, you're seeing loan demand slow, and the potential for credit issues as we move into 2024 as the economy slows. So the combination of those things make it, again, a challenging backdrop. Now, the flip side of that is valuation. Valuation is very attractive in this industry right now, and clearly there's a fair amount of bad news discounted. So may be getting close to a point where you start to look at these names and maybe potentially add to them. Again, we do have some exposure, as you mentioned, at the front end, but we're not adding to that at this point. I would expect, however, given the low sentiment in this area, you could see a rally like we saw last earnings season in these names.
But good to see you, Walter, this morning. But of course, that quarter by quarter, it's almost like it's such short-term perspective, isn't it? One big issue is, of course, whether peak rates and whether the banks are going to have to pay up and look large to hold on to their deposits. Those NIMs are getting slimmer. I mean, the air is getting thinner and thinner in NIMs. Who is most vulnerable, or are they all of equitable vulnerability?
Well, JP Morgan's kind of stands alone in not being vulnerable. They are seeing deposit inflows almost regardless. They are still subject to the compressing net interest margins, but maybe less so because of the First Republic deal. But outside of that, pretty much everyone else is vulnerable to a varying degree. As you go down the capitalization scale and get to smaller banks that don't have maybe other non-traditional bank businesses to offset some of that pressure, that increases the pressure on those. And so I think while we're talking about the big banks this morning reporting, I think PNC may be a better tell on the broader banking industry. They also report this morning because they would be subject, they'd be one that would be more subject to that dynamic.
I caught up with the Ares CEO, Mike Arangetti, who, of course, they've been sniffing around some of the assets from the fallout of SVB, who basically said to me, look, the U.S. is still massively overbanked. In this banking crisis, it will take 2 years to unfold. Do you think that, too? Is there still more of this saga yet to be figured out?
I do. I agree with the comment that we have too many banks still, about 4,000 banks in the U.S. And I think one of the dynamics that's interesting, and that you mentioned, Ares, is that this private capital dynamic did not exist in the great financial crisis. Remember back then, it was public money that had to come in and kind of save the system at that time. Much more challenging to get through the votes in Congress to get that money out. Now we have these huge pools of private capital that are looking to kind of fill the void that banks may have to leave. And so they're taking advantage of these opportunities and coming in and buying these loan pools that the banks need to unload. You saw Truist the other day selling the remainder of its insurance business to potentially raise capital. So I do feel good about the fact that you have other pools of capital that are able to step in. But I think this banking transition, if you will, that's going on due to the rapid increase in rates has more to play out. Doesn't mean we have to have another bank failure per se, but I do think kind of a consolidation, does need to happen.
But you would also make the point that part of the hindrance to that significant M&A rather than crisis M&A so far this year has been driven by crisis, 3 in a row, not through, let's say, desire to do a deal. And you say, of course, it's to do with the realization of losses on investments in the event of a purchase. And you're an advocate of what that being removed. Surely that's good, clean, honest accounting.
Yeah, it is. But if you could, potentially suspend that rule for a period of time, you might see more of these combinations happen. I mean, Treasury Secretary Yellen was basically.
But isn't that just transferring? Isn't that just transferring unrealized loss? I mean, that's just giving everybody an out. That's not good governance. That's just giving everybody an out so you can do a deal, isn't it?
You do have these, available for sale and held to maturity, different buckets here. And in a deal, you've got to recognize the losses in both. And so perhaps the held to maturity bucket, could be allowed to remain there. And if it's held to maturity, then there are no losses. But the dynamic is, of course, they have demand deposits that have to be met. And so those may have to be sold. So, yeah, again, if you go back to the financial crisis in 08, there were some things that were done to try to help, alleviate some of the combinations that happened then. The same thing could be done here.
I mean, he set you up for a tough one there, Walter, asking if there should be something different than honest accounting. Well handled. Look, the other headache that banks are potentially going to face is worsening credit conditions. It feels like we're on the cusp of an actual credit cycle for the first time in some time. Bloomberg data figures that $5.3 billion is going to be the combined third quarter net charge-offs, the highest since the second quarter of 2020. What do you think this downturn will look like, the potential deepness of this credit cycle?
Yeah, well, I think it depends on the kind of the bucket you're looking at. I mean, certainly there's a lot of conversation about commercial real estate and the potential impacts, of that as we move forward in the dynamics of, back to work or not back to work. So office real estate specifically, I think is going to be, hit pretty hard. And so I think you are going to see banks, continue to take reserves in anticipation of this credit downturn. So I think that's going to be probably the most acute phase of it. But I think a lot of the questions on the call this quarter are going to be about how's the consumer holding up. We just had student loans start back up here in the U.S. in October, and of course higher gas prices and inflation in general. So how's the consumer holding up? We are seeing delinquencies and charge-offs in the credit card space start to move higher, still low on an absolute level, but moving higher. Mm-hmm. So I do think that the credit downturn could be pretty decent, but I do think banks have started to take reserves. I think they'll continue to do that, try to manage through that. And of course, it depends on the individual exposure of the banks to the commercial real estate.
I think Jane Fraser is certainly going to be one to listen to, and Brian Moynihan on that front. When it comes to investment banks, our audience have their Bloomberg terminals. A lot of them are worried about their jobs. If you look at investment banking, we're expecting $6 billion, down from $6.42 billion. There's been incremental job cuts, silent job cuts, I would say. Not banner headlines, incremental. Every week there's another series of small job cuts announced. Is there something much deeper and more malevolent to come, or have we passed the worst in investment banking? Call the low.
I think the cost side of the equation for investment banks and banks in general is going to continue to be squeezed. And so I think they're going to continue to look to become more efficient, i.e. continue to probably streamline the employee force. I think that, unfortunately, that's going to continue. I mean, if you look at the deal backdrop, we've have had some decent IPO activity, but unfortunately, they haven't performed very well. If you look at the likes of ARM, Instacart, more recently Birkenstock. So deal activity is decent. We're having some more M&A, the Exxon Pioneer deal, but in general, it's pretty sluggish. So I think they're going to continue to streamline costs.
Hey, Walter, really great to have you up this early with us. Walter Todd of Greenwood Capital. Good luck for the earnings that are to come over the next few hours. All right, some breaking news to bring to you. The UK and EU are nearing a deal to delay post-Brexit EV tariffs. Should they not reach this deal, next year we would get a new tariff to kick in between EVs traded between the two blocs. It could be subject to a 10% tariff. This extension, according to people familiar, would delay that for about at least 2 years. Now, coming up, we're going to have more from the IMF meetings in Morocco. We're going to hear from Lithuania's central bank governor, Gediminas Šimkus, who is also a member of the ECB's governing council. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The differential of the Italian rates with respect to the German is relevant, but is far from that. And there are no signs really that it should rise really in a territory which would require us to intervene.
ECB Governing Council member Ignacio Visco speaking to Bloomberg's Francine Lacqua in the last hour at the IMF meetings in Morocco. Let's go back to Morocco now. Francine is there with another member of the ECB's Governing Council. Francine.
Yeah, thank you both. I'm delighted to be joined by the Bank of Lithuania Governor and European Central Bank Governing Council member. When you look at inflation expectations, but also a lot of the talk here amongst European central bankers is a main worry. It could be Italian spreads, it could be inflation going higher. What do you most worry about?
Well, I would say I am worried about, the general situation in the world, because it's definitely an upside risk for inflation. But still, I mean, we shouldn't rush into a conclusive statement. It's very early stages of everything. So I would say now, for me, it's that the biggest risk. Yeah. What regards you mentioned the Italian spreads or the situation.
Yeah, we'll talk about it will behave from now, and that it could all be upended because of the situation between Israel and Hamas.
Well, as I said, I don't think we should rush into, so to say, conclusive statements about this. So it has happened only last weekend. Yeah. And like from the European perspective, I would say there are a couple of things important to note. First of all, about gas. So gas storage is close to being full. That seems to be also a bit milder than before. And third, manufacturing, it's pretty weak. So the demand for energy is lower. What regards the oil prices, we shouldn't forget. So just before this was what has happened in Israel, the prices went down. Now they went up, but. For oil, it's very much so. The oil market is very much driven by the supply side too, and so I wouldn't jump into, so to say, into the conclusive statements. But I clearly see that this is an upside risk for inflation.
But Governor, so U.S. CPI was stronger than expected. There's also the Chinese consumer that could start spending more than expected. Is it automatically inflationary for Europe?
No, not really, because Europe is a very different jurisdiction where inflation was driven by different factors. Shocks, they were the drivers, but their effects are fading out, so clearly. Profits, we had this pretty, so to say, profits played an important role, but its role is also vanishing. And now the wages, so it's a question that they have peaked or they are close to peak. But nevertheless, we are growing pretty fast, like in the European Union, in these standards, according to the standards. But most likely, this increase will be, so to say, offset by the profits.
Governor, so the Irish central bank governor spoke about Italian yields, saying that they have to remain very vigilant, and then he suggested that he was concerned. Are you concerned?
So first of all, we should closely monitor what's happening in the overall financial markets, not only in Italy. But what has happened, so this increase in spreads for Italian bonds, I would say, for me, it's a clear indication how we should be prudent in all the policies we implement, including the fiscal policy. And I see that this jump in spreads is more, so to say, a reflection of a draft budgetary law and the new numbers that were revealed, and so where market reacted to these news. So. Yeah, so I would say so from monetary policy perspective. So that's a factor we should take into account when we're taking decisions. But I don't see a risk from the perspective of fragmentation, unwarranted events in the markets.
But Governor, does it change the conversations that you want to have regarding PEP or QT in general?
Not at all. For me, talk or discussion about PEP is basically monetary policy driven discussion. So let me come back to the time when the decision on PEP reinvestment was taken. It was early 2022. And at that time, we projected inflation for this year to be 2.1, as far as I remember, %. Now we project 5.6, almost 3 times higher. We project 1.9 for next year. Now we project 3%. I'm meaning that...
So you would stop it earlier?
I think we need to discuss, because the situation has changed. It's very obvious. So whether after the discussion, we take a decision to change something. So it's a question.
Yeah, but you would stop it earlier?
I think there are all the preconditions to consider stopping it earlier.
Okay, Governor.
Reinvestments.
Reinvestments. Governor, thank you so much for joining us. Of course, that was the Governor, Mr. Šimkus of Lithuania. We'll have plenty more from Morocco throughout the day.
Some pretty thorough thoughts there, Francine. Well done. Francine Lacroix on the ground at the IMF meetings in Morocco throughout the week, right here on Bloomberg Brief.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London. Manish Krani is in New York. Let's get you set up for your trading day and a look at what is ahead for the next 24 hours. JP Morgan, Wells Fargo, Citi, and BlackRock, they'll all report results before the U.S. market opens. And don't miss Tom Keene's conversation with the IMF Managing Director, Kristalina Georgieva, ECB President Christine Lagarde, and the WTO's Director General at 9 a.m. Eastern. That will be followed by the University of Michigan consumer sentiment data at 10 a.m. Where are inflation expectations, Manus, especially given, of course, it won't capture this, but inflation expectations given we've seen this momentous move in oil, not just this week, but especially today.
Absolutely. I mean, in the past hour since we've been on air, there's been yields have dropped. There is this geopolitical angst. There's concern about a ground invasion from Israel into Gaza. That has spooked the markets. There's an evacuation decree has gone out, Danny. And this is the risk, that we spill over and there's something more direct between Israel and Iran. And that affects oil flow. That affects the production and the exports from Iran that has been quite loosely regulated in the past couple of years by the White House.
I got to say that chart is really remarkable because you can see the round trip that oil does, and you can see what's happened today. This more than 3.5% gain, something that is very rare for these early hours. Manus, you mentioned this. The team over at Bloomberg Economics says, should there be escalation in the Middle East that involves Iran, $150 is what the models are reading out for oil.
And that's Ziad Daoud and the team, and they talk about, and it is based on the premise, and we must put this caveat in, if there is an escalation, if there is a direct conflict with Iran, A, a global recession, B, volatility would spike, and C, perhaps the most prescient issue of all, oil could spike to around $150. Blast started the week saying it's not 1973 today. It doesn't look like that, but it looks very, very punchy. Danny.
And maybe that's also putting a bid in for havens, a bid for gold, a bid for treasuries, lower by about 5 basis points after that 16 basis point ramp up, the worst day since 2020.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Unfortunately, even though the situation in the Middle East is very volatile, the market has gotten used to looking past events like these.
I think the market is just trying to find this equilibrium right now.
If I'm right that inflation gets down to 2%, then a 10-year Treasury at about 4.5% sounds about right.
I wouldn't be surprised if the 10-year does cross 5%.
You're going to see some form of yield curve control brought in to stabilize the bond market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a volatile week so far this week. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Together this morning with Lisa Abramowitz and myself is Anne-Marie Hordern. Your equity market on the S&P 500 is negative by about 1/3%. Under surveillance this morning, 24 hours of Treasury market volatility coming off the back of the worst day for the long bond since 2020. Boston Fed President Susan Collins weighing in saying this: the rising long-term yields imply some tightening of financial conditions, and if it persists, it likely reduces the need for further monetary policy tightening in the near term. That's where our focus begins, Bramo, this morning.
Except that what we saw yesterday in the market didn't necessarily have to do with Fed speak. It had to do with an auction that didn't work that well, a 30-year auction. There is a question about whether the Fed has lost control of the narrative, and that, to me, is really the story. Fed speakers can keep coming out again and again, Patrick Harker today, and yet the takeaway to me is that they've lost control, and the market is just whipsawing around what they perceive to be inflation.
Lisa, it's easy to blame CPI, but I'm with you. This was about supply. It was about a 30-year auction, Anne-Marie, that came in really, really soft.
Yeah, it did, and I think everyone's going to point the finger at Washington this morning for a number of reasons. They don't have a Speaker of the House, but also what's going on in the Treasury market. When you look at what the Congressional Budget Office continuously stresses and puts out, our interest payments are growing. In 28 years, the biggest line item on our federal budget is going to be paying off our interest, more than entitlements, more than Social Security. That's a big problem.
It's a massive, massive problem. We'll be talking about it through this morning. Also need to talk about bank earnings kicking off. JP Morgan leading this hour, followed by Wells Fargo and Citi. The KBW Bank Index down 24% this year, failing to recover from the SVB collapse back in March as new regulatory proposals, unrealized portfolio losses, and rising bad loan write-offs weigh on banks. The write-offs, Lisa, I've got to say, big focus going into JP Morgan, Citi and Wells later on this morning.
And it's not necessarily because of an existential question around the banks. It's much more simply to understand where we are in terms of credit heading to small businesses, to consumers. It's sort of the macro question rather than the micro existential, will banks collapse question that we had back in March. That seems to be kind of not in the works right now.
Far more interested in Bank of America next week.
Agreed.
Maybe than JP Morgan. That stock just absolutely hammered so far this year.
And they catered to a broader base of small businesses. It seems like there's been attrition of the lower income players, both in the consumer space and the business space when it comes to a lot of the bigger banks. Which banks are most leveraged to some of these smaller players, which is the reason why I'm actually very interested in PNC coming out at 6:30 this morning.
The JP Morgan about 43 minutes away. Also need to go to our top story. All week, dominating the headlines, Israel calling for an evacuation of the roughly 1 million civilians in Gaza City, indicating a ground invasion could be on the horizon. The UN warning it's, quote, impossible for such a movement to take place without devastating humanitarian consequences. Israel's military has stationed as many as 300,000 personnel outside Gaza, while Hamas has said it will begin killing hostages should a ground invasion come. How difficult the next couple of weeks going to be?
Oh, it's going to be incredibly challenging. And what you see from the United Nations is they're saying we cannot move this quickly in terms of moving Palestinians, moving everyday civilians out of Gaza, especially in the north. So this is going to be incredibly challenging, and the images are going to be horrific.
And it's igniting so many passions around the world. Today, Hamas called for a day of rage. There are a lot of places that are closed. Police presence is very high around the world. When you talk about, is this contained? Well, maybe this is contained in terms of just it hasn't escalated into a regional fracas, but globally, this is percolating out onto the streets into every city around the world.
Greg Valier coming up a little bit later on this morning. We'll catch up with the man from AGF Investments in about an hour's time. With us around the table this morning, Greg Bowdle, Head of US Equity and Derivative Strategy at BNP Paribas. Morning, Greg.
Good morning.
What a week. What a week in this bond market. This bond market seems to really spook equity investors. I'm not sure we've had to deal with this for a long, long time. You get a soft auction on the 30-year. What do you do with that?
Well, I think the interesting thing is that it has weighed on the equity market, but to say it's spooked equity investors, it hasn't injected any volatility into the market at all. So we've still seen an environment where it's been relatively benign. We've had some decent down days from the S&P, but they've been isolated pockets, down 1.5%, flat, rebounded. We haven't had real volatility injected into the market.
People want to see stability in treasuries. I've been asking a question. When they say stability, do they mean lower yields or smaller moves?
Smaller moves, sideways moves. I think for the equity market, given the growth backdrop and some of the strength that we've seen recently in the data, then a lack of volatility from the fixed income space might be enough to see equities perform in the short term.
But this, to me, is a fascinating point. It's not saying that when yields bounce around like penny stocks, that's actually a problem for stocks. You're just simply saying, well, if they stabilize, then stocks can rip. And this seemed to be what Bank of America Michael Hartnett was saying. As long as 10-year yields, 30-year yields don't breach significantly above that 5% mark again, we will avoid the worst-case scenario and things will chug along. Do you agree?
I think it depends whether we're talking about a short-term tactical view, 1 week, 1 month out, or whether we're looking a little bit further out the time horizon. What matters as we go over the back end of the year into next year is really the effect of those higher yields on the real economy. If we start to see a macro slowdown from the effect of higher rates, then I think it can be a much more difficult environment for equities. Tactically, in the short term, I think a lack of a move higher in rates is enough to give some relief to equities.
Do you feel like, in some ways, people are getting more confidence in risk appetite simply because nothing has broken yet amid all this volatility?
Yeah, absolutely. There's this kind of self-perpetuating cycle that when you have negative news flow and the market doesn't respond, behaviorally, the right thing people think to do is therefore to buy on dips. And we've certainly seen that this year. When the market broke up through 4,200 in June, we saw huge inflows into the equity market. And we think that was a lot of capitulation in terms of some of the more recessionary bearish narratives. So, ultimately, behaviorally, being underweight stocks has been the more difficult position. And that's why people, we think, have put a lot of money to work. But ironically, that increases the downside risk a little bit from a positioning perspective.
Is the Fed done?
Our view is that the Fed has put in its last hike, but obviously it depends what happens with the data, right?
So December's a live meeting. Morgan Stanley think they're done, but ultimately they still say that December's a live meeting. November's dead. Ultimately, the Fed speakers have pushed cold water all over that. Do you agree with that?
I think that, there's always risk depending what happens with the data, depending what happens with oil, depending what happens with inflation. There's always risk that the Fed have to go again. But it's not our base case.
When you say that there are all these risks, and it's a pretty wide parameter, especially right now, Bloomberg Economics came out and they said there is a risk that if Israel does go directly after Iran, oil prices could go up to $150 a barrel, and you could get some sort of significant recession that takes $1 trillion off the global GDP. How do you plot the potential for something that could be a scenario, but is an unclear likelihood? How do you frame out what we're all wondering, these sort of existential questions?
Yeah, frankly, that's the problem that equity investors have been dealing with all year. It's the reason why people, including ourselves, have been too bearish on the market, is that we've seen a slowdown coming and it hasn't manifested. So ultimately, the thing that we've been focusing on is trying to set up trade ideas, portfolio construction, such that you can weather a more benign environment for equity, but get exposure to what we think are some cheap tails to protect yourself from the more recessionary environment that, even absence that type of evolution of events, we still think a recession is coming in Q1 regardless.
What are you looking for in the bank earnings that we're starting to get, I believe, in about 22 minutes?
Yeah, the bank earnings are going to be super interesting. One thing empirically, in an environment historically when yields rise and yield curves steepen, the banks have been the best performing sector historically in that environment. But we know that hasn't really been the case this year given what happened in Q1. I think one of the most interesting things coming into this quarter is that there's an absolutely massive volatility premium in the bank stocks. So clearly the market is concerned about what they're going to hear from the banks. The question for us is that concern more related to something idiosyncratic for the banks, their balance sheets, or is it more a reflection of a slowing in the macro and something we can read to the broader market?
What have we learned from how the bond market plays into what happens with bank stocks? Ultimately, the high yields hurt them, right?
Yeah, I mean, the disorderly move in rates, the volatility, the nature of the kind of dislocation we've seen in there isn't something that they've been able to digest.
How much is it, are you looking at some of the charge-offs that we've been getting and that we're expecting to see with respect to credit write-downs? How important is that from a macro perspective to paint your view of credit and the impulse into the economy?
I think it's really important because our narrative into the back end of the year is that the economy will slow, that the consumer is at risk, that the effect of the tightening the Fed has done will be making its way slowly into the real economy. So far, we haven't seen a ton of evidence of that manifesting, and this is one of those data points where we will look to that. And if we do have a negative surprise in terms of some of the detail of the bank earnings, I think that is something that is going to weigh on the market.
What's your highest conviction call right now?
Highest conviction call for us right now is to be short the consumer discretionary names. Not necessarily through this earnings season, but looking for any type of relief rally that we see through earnings for next year. We just think the effect of the slowing economy, the higher rates, that's one of the kind of subsectors of the market which we just think is most at risk going into Q1 next year.
LVMH called the top, right? Is that what you think?
We'll see.
I'm looking for indications. I don't really see it outside of, say, some companies saying things are a little softer.
No,
Do you see it in the data?
No, I think that's one of the things that we haven't seen this year. It hasn't really started to manifest yet. But the issue with slowdowns, recessions, is that they can start quite slowly and then accelerate pretty quickly. We think the effect of higher rates is just something that will mechanically have an impact on the consumer. We know we've had this story of excess savings that we're working through. So I think the fact that this has taken a little bit longer than everybody, including ourselves, thought it would to play out, doesn't mean those effects are not going to be there.
Greg, thank you, sir. Greg Barrow there of BNP Paribas. Let's go through the bond market, Bramo. 30-year. The 30-year at the moment has a yield of 4.78. The 30-year yesterday had a move of almost 20 basis points higher, and it's still below 27 basis points below where we were a week ago Friday intraday.
By one measure, it was the biggest one-day pop in yields on the 30-year going back to the height of the pandemic in March 2020. This is the type of volatility that we're talking about because even though the U.S. sold 30-year bonds at the highest yields that they have going back to 2007, they couldn't attract the buyers. One soft auction after another. It raises a question, is this a buyer strike that is temporary or something that is more permanent and structural in nature?
Thinking of Daleep Singh of PGIM, who spoke to us recently and
Yes.
talked about the loss of predictable buyers. The price-insensitive buyer has taken a back seat. We're still trying to figure this out.
100%. This is still a question mark. We don't understand why the market has been bouncing around to the degree that it has. People have different theories, and people are solidifying on a sense that maybe we're just topping out at some sort of level and that this has to do with the Fed. At this point, it doesn't really have to do with the Fed. It has to do with other things too. Yes, the Fed, it's a part of it, but they're kind of losing control over the long end, and that's why we heard Michael Schall say maybe they'll try to get control, a very controversial idea. I got a lot of pushback yesterday as a response to this, and yet these are some of the discussions that you're hearing in the market right
Look,
now.
there's a price for everything. I was speaking to Greg Peters of PGIM yesterday, and we tried to work through some of these issues. And the bottom line is basically this. Why would you want to take on a longer dated maturity with less yield in an expansion? Until we get really soft economic data, people aren't going to be willing to do that. And ultimately, maybe that's why we're seeing the curve disinvert as much as it has done over the last month or so.
And the fact that we've seen better than expected data, you asked just now, Greg Battle, have you seen any signs of that consumer softening? The answer is not really. If you take a look at all of the different parameters in economic data, it has been stronger than expected again and again. The fact that we haven't seen even higher yields, a lot of people say, is just the risk appetite has really waned in light of the conflict, and that's dampening yields that otherwise might be substantially higher and substantially more disruptive.
AMH, we were talking about this in the last couple of weeks. Are we very close to officials in Washington waking up and checking the price of a 10-year yield every single morning?
You think so, right? When you're sitting in New York, but not really. I mean, still don't even have a Speaker of the House. The issue is, and Michael Shaul talked about this yesterday, is there needs to be more fiscal discipline. That's reining in spending, but also increasing taxes. When you look at the makeup of Washington right now, neither of those things seem to be possible in a bipartisan way.
And basically what you're hearing from investor after investor is they're not going to get their act together. Have they ever gotten their act together? The discussion isn't even on the table. So if they're not going to get their act together, what's the new term structure? What do we have to adapt to? And note after note has come out and said, you know, we could probably live with this. As long as it doesn't get too out of control, we can live with this.
What's the comedian say? Aren't you embarrassed?
Aren't you embarrassed?
Which comedian's that? Sebastian Maniscalco?
Yes, the Italian.
So. Aren't you embarrassed? I mean, that's how I feel about Washington, D.C.
Yes,
right now. Like, they don't seem to be embarrassed at all.
Not at all.
And it's the sausage making in real life.
It is not a sausage. It's bolognese.
Sausages taste nice sometimes, right?
Exactly.
There's nothing tasty about this.
Not at all.
Coming up, 6:30 Eastern Time, Gerard Cassidy of RBC Capital Markets counting it down to JP Morgan earnings this hour. From New York, good morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Iran has had a long relationship with Hamas, and Hamas wouldn't be Hamas without the support that it's gotten over many years from Iran. Having said that, when it comes to this specific attack, right now, as we speak, we haven't seen direct evidence that Iran participated in or helped plan the attack. That doesn't mean that it didn't. We just don't have the evidence to show it.
That was Secretary Blinken, the U.S. Secretary of State, speaking to ABC from Israel. The latest on the Israel-Hamas war. Israel calling for an evacuation of all civilians in Gaza City. The United Nations get 24 hours to move its staff from nearby areas, indicating a ground operation, Lisa, could be coming very soon.
And the UN saying that it's going to be very difficult to move 1.1 million people out of Gaza City in 24 hours, asking for more time. There is a bigger question here, which is how do you protect the maximum number of civilians as we see an increasing incursion that has demolished entire parts of the Gaza region? And this has been something that it has an escalating feeling, and we heard that from Tony Blinken yesterday, to basically use some discretion and restraint at a time of incredible conflict.
Joining us now to discuss is Paul Libbs, the Professor Emeritus at Tel Aviv University. Professor, wonderful to catch up with you, sir. Can you run us through the scale of what you imagine is about to play out?
So I think there are a number of alternatives. Firstly, I think one has to remember that part of what might be said publicly is not necessarily what is actually going to be implemented. So I think one has to be fairly careful of taking everything that's said publicly as being what the final word is. But I think what has happened here is that this is a different kind of conflict that any conflict that Israel has ever faced. This is defined very much in terms of the Holocaust, where there was a real attempt to wipe out the whole of Israeli society. So in that kind of situation, and I know it's kind of maybe hard for America to imagine what it is from the Israeli side, we actually believe that if Hamas had managed to get a little bit further into the country, it would have been the end of the state of Israel. So we're speaking about a war of survival. We're not speaking about a war which is only about, who gets killed and who doesn't get killed. It's much greater than that. And in that context, I think the general opinion of Israeli society is actually saying, well, we're going to have to show Hamas once and for all what's going on. Now, what is Hamas? Hamas is the accepted political body of the Gaza Strip. 2005, 2007, there were elections, and Hamas was invited, told by the public that they should be the government in power. And that government in power has said very, very clearly that they are determined to wipe out the whole state of Israel. I have in front of me, by the way, the documents of the Charter of Hamas of 1988, which is the basic principle of what Hamas believes in. And they say very, very clearly, and I won't bore you with all the sentences there, but basically they say there that our goal is to wipe out Israel. So we're fighting for a war of survival. Well, and in the war of survival, certain very tough things are going to happen.
Professor, there is also a question about Israel's survival without the international support, and there's a question of what kind of international support Israel could lose if some of these images escalate and a significant civilian toll is exacted on the Palestinian people. So how do you understand some of the discussions, the proclamations that you say, take them as simply messaging, not necessarily the final word? How do you understand how Israeli officials are trying to limit civilian casualties while also preserving their survival?
That's a very difficult situation. In war situations, unfortunately, innocent people are killed. And if we look at the end of the Second World War, we know that millions of people in Dresden were wiped out. They therefore broke the accepted regulations of war. So Israeli society would want to remain within the broad acceptance of what should be done and what should not be done. Until now, the approach has always been in Gaza, telling people in certain buildings that they will be attacked and that they should move out of the building, because we have not wanted to kill vast amounts of people. Certainly from my point of view, that would be the last thing I want. But I would want to say that in the war of survival, we would like to remain within the accepted regulations of what happens in a war, which, by the way, very few countries have ever done. So although there are these regulations, very few countries actually abide by it, particularly when it's a war of survival. And therefore, I believe that we would try as much as possible to remain within the regulations until it seems that we will find ourselves in a situation in a few months' time being under attack again. And we don't want this to happen a second time. So I think the Hamas has to bear the burden of responsibility. And when we're looking at any war situation, we have to ask who started. And if you start a war and you try and kill innocent civilians, which happened in Israel, then unfortunately the result on the other side might be problematic. I'd just like to say something about support. I can never remember, and I've been in this realm now for 50 years, I can never remember the level of support which Israel has received from some of the countries, as has been the case. The lecture, the presentation a few days ago by President Biden was without doubt the most important statement of American support to Israel. And I hope that that support will remain. And at the same time, I hope on our side, we will be as careful as we possibly can not to cause wanton damage.
Hamas said this morning that 13 hostages were killed, Israeli and foreigners, due to Israeli airstrikes. Is Israel going to take the hostages into account before they start what is looking like a ground invasion?
Well, I just want to say something about ground invasion. It isn't always what one expects it to be. It can be a whole lot of in-between actions as well. So it's not just the mass ground invasion as sometimes people imagine. Look, we've got a major problem here. We want to destroy Hamas because Hamas has designated its goal as destroying the state of Israel. And at the same time, we have hostages there. So this is always a very delicate kind of situation. I do not take Hamas's comments all that seriously. We found in many cases they've given information which is totally incorrect. Be it as it may, we are caught in a very difficult situation. And one point of view would be, just let's give in to all the Hamas demands, and then we will get our hostages back. And that would mean that in a few months' time, we're once again in the terrible conflict. Or do we find something in between? And I won't go now into the possibilities, but the possibilities do exist where I think we can save, hopefully, most of our hostages, while at the same time, perhaps causing damage to Hamas, the terrorist organization, which would not harm the wider population more than necessary.
Professor, thanks for your time today. Paul Lips there of the Tel Aviv University. The latest, if you are just tuning in, Israel calling for an evacuation of all civilians in Gaza City, giving the United Nations 24 hours to move its staff from nearby areas. Strong indications this morning of an impending ground operation. This came from the UN, the response from the United Nations. The UN considers it impossible for such a movement to take place without devastating humanitarian consequences. Emery, it goes without saying, this is a really delicate moment right now in the Middle East.
Incredibly delicate. And Secretary Blinken said yesterday how Israel does this matters. He said, we democracies distinguish ourselves from terrorists by striving for a different standard. It's going to be incredibly difficult to get these people out.
It's also going to be incredibly difficult, I think, just for cities worldwide as everyone deals with the very heightened emotions. And this is something that we can feel. This is not a conflict that is isolated to one region. This is a conflict that goes deep.
We'll stay on top of the story through this morning. For Wall Street, the focus on banks. JP Morgan about 20 minutes away. Joe Cassidy of RBC Capital Markets is going to be joining us to anticipate the numbers just around the corner and look ahead to next week as well with Bank of America results on deck. Live from New York City, this is Bloomberg.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
We had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Snapping a four-day winning streak on the S&P 500 in yesterday's session. Your equity market this morning, the follow-through negative. On the S&P, we're down by 1/3 of 1%. On the Nasdaq, we're off by 1/2 of 1%. This week, Lisa, what a wild ride so far this week.
And honestly, trying to get a message is basically like trying to read something out of the clouds. Frankly, it's been so difficult at a time of such diverging pressures, whether it's geopolitical risk or just this feeling. Data comes in hotter than expected. Some people are saying that the rise in yield yesterday was because of CPI. Okay, right. We didn't see the move until after the auction, so I kind of reject that. I think there's a lot of stuff going on that's technical.
I think the chart speaks for itself.
I think so
You look
too.
at CPI, yields start to climb a little bit and then bang.
Exactly, thank you.
Auction happens,
Yeah.
and that's when it starts to spook equity investors as well.
Did people really care about PPI? Did people really care about CPI? Or all of a sudden were people saying, wait a second, technically this doesn't feel right, we don't feel stable, so we can't really get in, and we're going to stay on strike?
People are confused by what is happening with the auctions. And I think they're spooked by it. You see a lot of money come into the market, a lot of treasuries, then you get a really weak auction, even with yields at the highest since something like 2007 for a 30-year issue. Demand just isn't there, Bramo. Demand just is not there.
And then you also have what you have with banks not really having the appetite to really come in with any heft and pick up the slack. So they were forced to have 18% of the auction yesterday. That's not that significant, but they were forced to. They would not have wanted to pick this up.
I keep saying this, even with yesterday's move, yields up aggressively. We're still 27 basis points below where we were last Friday after payrolls on that cycle high. Your 10-year, 461.65, yields lower by about 8 basis points. Let's finish on foreign exchange. Yesterday, yields up, dollar stronger against everything in G10. This morning, the euro back at 105, but just about unchanged here, Bramo, at 105.23.
What we're watching today is definitely going to be bank earnings. It's going to be really important. Any minute we're supposed to get PNC earnings. We will bring that to you when we get that. I personally am interested in that, although everybody else is looking to JP Morgan in about 15 minutes time, followed by what we're expected to get from Wells Fargo around 7 a.m., Citigroup around 8 a.m. Throughout the day, we'll get analyst calls, 8:30, 10, and 11 a.m. respectively. 10 a.m., we are getting that Facebook Live presentation from the UAW President Sean Fain, even after the surprise strike, even after Ford said, we have offered what we can offer, forget about anything additional. What more are they going to say? I mean, this is really a question. At a certain point, what do they want? I don't know.
It felt like an escalation yesterday. It really did. We're going after the F-Series trucks, and Ford basically turning around and saying, that's it, you've had your offer. These are the parameters, need to work between them.
And I couldn't tell whether it was an escalation of emotion or an escalation of tactical planning. And I think maybe we'll get a better sense of that in the days to come. And 10 a.m., John's favorite, the University of Michigan Sentiment
Didn't
Survey.
get the call.
No, not this week either. Every single time we have this, I'm going to ask you, did you get the call?
I will be so happy when I finally get that call.
And you are going to give them ridiculous estimates.
I need to work out how to record it. I just need to work out how to record it. I'll give honest estimates.
Will you?
Yeah, absolutely.
Are you going to give like
where I think inflation is going to be in 5 years?
3.1%.
Like 3.2567, something like that.
9, 10.
Yeah, see what they say back to it.
Okay. Anyway, we get that at 10 a.m.
Looking forward to it. We'll get earnings this hour as well. Lisa talked about PNC. PNC. JP Morgan coming up in about 15 minutes' time. Let's get to our chief Wall Street correspondent, Shonali Basak, with us around the table here in New York. Morning, Shonali.
Good morning.
What are we looking for?
We're looking for how much net interest income is finally facing some pressure. You're looking at an expectation of it for it to decline from what was record levels that you saw a quarter ago, that boost they got from First Republic. But even behemoth JP Morgan is facing some pressure on business lines like trading as well. So the overall picture, what does it look like for things starting to turn around into next year? Citigroup analysts estimate that it'll be the second quarter of next year before you see net interest income start to rise at a lot of these banks. Remember, loan demand has been pretty muted. A lot of questions about how much capacity consumers have to take on more loans, especially in the higher interest rate environment. Credit cards are being maxed out at this point in time. How much does that start to feed into credit quality as well? For behemoth JP Morgan, how much are they willing to take that pain when it comes to credit losses? Because it will be a bellwether for the rest of the industry.
Let's talk about that. So of the big names, JP Morgan, Citi, Wells Fargo, Bank of America, all of them combined, we're going to hear this number potentially posting roughly 5.3 billion in third quarter net charge-offs. For our audience who are following this, who aren't familiar with the banking jargon, what are net charge-offs? What does that number mean?
It is when loans start to sour. People have a harder time paying back loans. And listen, that $5 billion, yes, it looks scary. It's $5 billion. It's the worst since the second quarter of 2020, the start of the pandemic. However, for banks, it's a calculus. Are they making more money than they're losing? And if they're lending into a market where they're willing to take $5 billion worth of losses off of those loans, that's not a bad sign, is it?
Well, and I was thinking about permacrisis yesterday in your conversation, how we're all kind of conditioned to the banks are going to fail rather than it just isn't going to be as profitable, and the sort of calculus that Shonali is talking about. That's what I was thinking about.
Existential crisis on the one side, profitability issues on the other side. Bank of America in the middle. Whenever treasuries sell off, that bank suffers. What's happening over at B of A? Never mind JP Morgan in 10 minutes' time. Bank of America next week. What's going on there?
Let's take JP Morgan versus Bank of America, because it makes me laugh a little bit here. Timing the market in treasuries. You have Bank of America taking in deposits, plowing those into treasuries when they were still at interest rates sub 0% or so. And now what you have is Bank of America holding all these bonds that they bought more expensively. They have sold off, and it is weighing on the stock, and it's weighing on the stock more than any other big bank, just for investing in the U.S. government.
Well, and this is something that they're all going to be dealing with. The other flip side of this is, when are they going to have to start paying some of their depositors a little bit more? Because I can tell you, as a banking customer with a major institution, I am not seeing it in my checking account, my savings account either. A lot of people aren't. Do people protest? Is that inertia starting to change when you're getting 5-6% elsewhere?
They're certainly protesting other things, but that 1.1% savings rate that you're still getting at these big banks, you have to get into the promotional CDs if you want that higher rate, or a fintech bank, SoFi, or even Marcus, where the rates are much, much higher, because they still want to bring those deposits in. But Bank of America and JP Morgan are still saying, we don't need your money yet. We have plenty of money, and we are still figuring out ways to deploy it because we don't know. Jamie Dimon has been weighing that risk of rates going to 7%. And so is this the point to get into the market more if that's what you believe the risk is?
I think we've got to make a really important distinction. There is a difference between a CEO of a bank worried about rates going that high and preparing for that, basically making sure they're insulated from it, and a bond market strategist coming out and saying, Bramo, we're going to 7%. We're going to 7% on a 10-year.
I mean, and then he was asked later by Bloomberg, by Emily Chang, could you see 8%? He's like, sure, we could see 8%. I mean, this is like, why not? Where are we going to go? 10, exactly.
Somewhere Bob Michael's just like this. Please make it stop. Please make it stop.
Why? Just stop talking. At this point, though, there is this feeling. He's just saying we're just absolutely bulletproof. And that's really the message that he was trying to send,
but
not a projection.
That kind of preparation has really prepared him to really buck the pain that Bank of America saw. He didn't time the market per se, but he did avoid that risk of rates going much higher.
So true. Shonali, stay close. We're going to break down these numbers together in just a moment. Joining us now is Gerard Cassidy, the head of US Bank Equity Strategy at RBC Capital Markets. Gerard, wonderful to catch up with you, sir, every quarter to do this. It always is. What are you looking for from JP Morgan and the team in about 8 minutes time?
John, it's a great stock to look at, a great company to look at for a number of reasons, because the read-throughs are in all the different banking businesses. As you know, JP Morgan's a very diversified revenue company. And so we're going to be looking at the consumer business lines. How are they holding up? Did they grow much this quarter? Looking at the levels of charge-offs that you guys just talked about. On top of that, we're going to look at the investment banking activity. It's one of the premier investment banks as well. And then you're looking at wealth management. They have one of the premier wealth managements. And then, of course, we're going to be looking at that net interest margin and net interest income and to see the effects of rising deposit rates on those line items.
Jared, just on the bad loans, the economy looks good on the headline numbers. What are you actually looking for with regards to how much money these banks will set aside to cover those bad loans?
I think we're going to be surprised to the positive side, John. I think what you're going to see is the provision, to your point, what money is being set aside. We have the new accounting rule that went into effect January 2020, and that's called CECL, Current Expected Credit Loss Accounting, and they have to look through the cycle in preparing for these potential losses. And so I think with this quarter's third quarter real GDP number coming in most likely better than expected, maybe there's a little bit of a backing off. But to your point, I was just looking at our model. And if you go back to 2019, 2020, this company was charging off just over $5 billion of loans every year. That number dropped in 21 and 22 to less than half of that, or about half of that. And so what you're seeing today is a normalization of credit. So even though it's going higher, this is where we were pre-pandemic.
I'm going to feel kind of bad after asking this, Gerard, because on one hand, it's always kind of nice when you see less risk. On the other hand, it's less profitable. And on one hand, you could say, okay, fewer charge-offs means that the economy isn't doing so badly and that the loans are safe. It could also mean that they're not banking with the riskier and also more lucrative clients. How much is that part of the story and challenges some of the profitability and ability to capture yields at these higher levels?
Lisa, a very good point, and they have de-risked their balance sheet. Following the financial crisis, as you guys all know, the banking industry, the big banks, go through an annual stress test. And as part of that stress test, there's been a de-risking of the bank's balance sheets. And the shadow banking industry has stepped in more aggressively and taken on those risks. So it's a risk reward that Jamie Dimon, Brian Moynihan, all the CEOs do with their banks. They measure the level of risk versus the profitability. And the industry today is far less risky than it was in 2006.
Given the fact that there is less risk and also less potential for profit, they keep complaining that the private debt and equity players are eating their lunch. There is a question about what's baked into the price. If there are materially lower charge-offs, if they do show much safer business models, will that be good for their stock or bad for their stock?
That's a great point. And we really have to go through the cycle, because if this industry, led by JP Morgan and all the other bigger banks, can demonstrate that we can get through a traditional recession without having dividends cut, without having depreciation of book value, they will then get revalued higher, almost similar to utilities, not as high as utilities, but they may turn themselves into financial utilities because of that safety that they can get through a recession without having dividend cuts. So you're right, though the profitability could be less, there could be an upward revaluation because it's safer to be in the bank stocks than it was in previous cycles.
After the collapse of several lenders, Gerard, earlier this year, what you hear from Washington is all these U.S. regulators want banks to add more cushion to their capital requirements. That's expected to be coming. How are these banks preparing for that?
What you're likely to see is that they're going to lower their size of their risk-weighted assets. They're going to mitigate some of that through downsizing different lines of businesses. But these rules, as you know, are probably going to start being implemented in the summer of 25 over a 3-year period. And so the way they're going to raise this capital is through retained earnings. And so they'll shimmy down a bit the balance sheet. But on the other hand, they'll be growing profitability through the next 2 to 3 years, and that will build up the capital to get to these numbers. And you're right, the regulators certainly want more capital. They're likely that they are going to get it, and the industry will be able to reach it. We're not worried about that, but the profitability will be affected.
Where does that leave capital returns, Gerard?
John, good point. Once we get to these targeted levels on capital, the capital returns will be very robust, because typically, as you know, the industry grows earnings at a rate where they cannot redeploy it effectively on an organic basis at returns that investors want. So as a result, they have to give it back through share repurchases and dividends. And once we get to these new capital levels, which we think the industry will get there by the end of 25, then you're very likely to see the industry or the big banks give back anywhere from 70 to 75% of their earnings in dividends and buybacks.
What a year it's been for this industry. Jared, stay close. Jared Cassidy there of RBC Capital Markets, sticking with us to break down JP Morgan results. About 3 minutes away. JP Morgan year to date, higher by 9%. Lisa, Bank of America, down by close to 20. The outperformance, the relative performance between those two names this year has been remarkable.
I mean, Sonali nailed it with the idea that they have huge portfolios of treasuries, restricting their ability to lend, and they're more highly levered to smaller businesses and to consumers than JP Morgan. So it raises this question, with these earnings, does Bank of America have a bigger chance of surprising to the upside, frankly, and a lower bar to beat than JP Morgan, the fortress diamond?
Which is kind of what Jared Cassidy said, right?
Exactly.
That maybe the bar here, Sonali, is a little low.
Yeah, they're trading most expensively from a price-to-book basis, more than any other bank. They're trading at 1.5 times book value, while every other bank except Morgan Stanley is below. If you can imagine, Bank of America at 85% of book value, they say when you're trading below book value, you're burning at value every day you're alive. And you can't imagine that from the biggest banks in the country.
It sounds brutal, right?
It's like, I hope that I'm not burning value every day of my life.
Bank of America, a real struggle. JP Morgan results coming up next. Your equity market negative on the S&P. We're down a third of 1%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
Rise in long-term yields implies some tightening of financial conditions, and if it persists, it likely reduces the need for further monetary policy tightening in the near term. This reinforces my view that we're very near and perhaps at the peak federal funds rate for this tightening cycle.
We're close, probably at the peak cycle rate. Susan Collins there, Boston Fed president, weighing in on the bond market sell-off we've seen over the last couple of months. Big moves we saw again yesterday at the long end on a 30-year yield following that soft auction. The 30-year this morning down about 8 basis points. Got some Wells Fargo numbers for you. Revenue coming in at $20.86 billion. The estimate, $20.16 billion US dollars. Sonali working through some of these numbers. Sonali, your thoughts?
Yeah, I mean, we knew that this was going to be a tougher quarter, and to the point that you're making here, they're just above estimates on revenue figures. That is a good sign because we're looking at things to hold up here. Net interest income coming in at $13 billion. That is above estimates as well, which shows you that Wells Fargo is lending into this environment. They are capturing that benefit of higher interest rates. The efficiency is still above 60%. Now, that efficiency number is an important one to keep a handle on because we're looking at job forces coming across these banks and what it looks like in a very pressured profitability environment. These also have large real estate footprints when you look at Wells Fargo and Citigroup and JP Morgan. So they may want to get a handle on that as the months progress.
Third quarter EPS 148, the estimate was 125. We talked a lot about provisions for credit losses. This is the number over at Wells Fargo for the third quarter, 1.2 billion, the estimate 1.33. How important is that number going to be over the next week? Numbers from Wells, Citi, Bank of America, JP Morgan.
It's proving what analysts are saying, that the provisions that we've seen are probably the bulk of it. All of the future economic pains that we see, maybe you've already seen those in the numbers. Should they think things get worse, the question in the calls will be whether we are going to see even more pain should the economy turn more, or are they already baked into the existing provisions?
We also see that third quarter net charge-offs came in also slightly below expectation, 864 million versus the estimate of 865.7 million. There is a question, though, about whether they're making fewer loans. Yes, they might be having fewer charge-offs, but we did see that with Wells Fargo coming in with fewer loans being underwritten than before. How much are people caring, or are they liking the caution and really liking that net interest income just keeps beating?
Listen, there's a sense that things can get much worse before they get better. And so that caution right now is being rewarded in the market. They want them to make money off of loans, but as we know, this interest rate story has been a real double-edged sword. They want to see the